Good morning, everybody. Welcome to the June edition of the Specialist Mortgage Web Show. Hope you're all well and prosperous, of course, and no doubt very, very busy, if you're anything like us at the moment. So we'll crack straight on. Lots and lots to cover today. I do apologise. I've gone down with a stinking cold this morning, and I'm rapidly losing my voice. If I sound a little bit like Barry White a little bit later on, there's not a lot I can do about it. I've taken paracetamol and other drugs, but they haven't really helped too much this morning. So anyway, so my name's Tony. For those that you don't know, for those new delegates that haven't been to one of our shows before, my name's Tony Sutton. I'm the Managing Director of Specialist Financial Services. I'm your host for today. A little bit of history on myself. We do this for all the speakers, just a little bit of history and hopefully an interesting fact. We've got a couple today that are very interesting. But a little bit about myself. Again, some of you will probably know this. Left school in 79 at 16. About half the size I am now, in a suit that was probably the same size as the ones I'm wearing. Looked absolutely daft. Had 4 years of Midland Bank. Got sick to death of sorting checks into alphabetical order, which is one of the jobs at the time. So in September 83, I put my name out of a few job agencies and landed a role with Cedar Holdings, who I'd never heard of them, but they're owned by Lloyds Bank, and they were at the time the largest second charge lender in the country, and also did commercial mortgages and a couple of other bits. Within 4 years after I moved to Bournemouth, which was great when you're 23 years old, I was made regional sales manager. I was the youngest grade 8 in Cedar Holdings history at the time, which would have been great. Well, would have been great if I was actually getting the money for it, because the managing director was a grade 12, but I think I was on 17 grand a year at the time. 1987, one of the brokers that was on my patch, I was headhunted by them, offered the world, as new employers sometimes do. Left 16 months later because the world that was promised never materialised. Set up my own brokerage at the age of 25. All the way back, it was 11th of May 1989, so I've just had 33 years of running my own companies. Grew a two-man operation with my former business partner with 141 employees at our peak, which I found, I must admit, that was something I didn't enjoy, because I just became a glorified HR consultant, was dealing with staff issues like staff fighting with each other, staff taking cocaine at 9 o'clock in the morning, all sorts of fun stuff that you have when you're an employer. Had a bust up with a business partner in 2001, 2002, 2003 and 2004. And by 2004, I thought I've had enough of this. So I left a large firm and started up by myself in my kids' playroom in my house. It was just myself, my wife, and grew that to a very, very successful operation before the recession hit. Because I was very lucky, because I was able to take all the really good stuff from my previous company. They all pretty much, I had something like 80 applications. I obviously took the cream, which was great for me. Not so good for my former business partner, because he went bust 8 months later. Continued trading throughout 2008. An idea of how bad it was, my turnover combined in 2009 and 2010 was less than it was in March 2008. That's really how bad it got. Stayed in the market. Because I stayed in the market and because of my contacts, it was when lenders either came back to the market or basically started increasing their terms, or new lenders come to the market with staff that have been in the market for a while. I was one of the first they approached. So Shawbrook was a good example, for example, and I think they were called White Way Laidlaw at the time. Very good example. One of the first brokers they took on. Same with Interbay when they came back into the market. Here we are, 2022. 5 decades I've been doing this, and don't I feel it? I really do. But anyway, interesting fact. I'm going to change this in. I'm going to need to do something, I don't know, like fall in the canal in Berkhamsted or something, because I need to find some more interesting stuff. But many, many years of my kids, I don't want to say begging, but nagging me stupid, I decided 3 odd years ago I'd start writing a cookbook, just so my kids could have recipes. Because my hobby is cooking, so that's how I unwind. If I get home early enough, that's how I unwind. And my wife prefers my cooking to what she gets in restaurants. So my kids were nagging me stupid. My son-in-law said to me one day, "Look, you need to get these recipes down, because you're going to die one day and you don't be going to your grave with these recipes." So I thought I'd write them all down, which I have now done. It's not been published or anything like that. It's just a bit of fun, but my kids absolutely love it. So if any of you want a copy, it's not available, unfortunately. But I know a lot of their friends have actually been taking photocopies of pages over the years. So Our sponsor for today's event is West One, who are presenting our first presenter today. So thanks to West One for their sponsorship. If you can't hear or see us, might sound dark, but mainly if you're on a mobile, this probably applies. Just go into the type your message in the bottom, and we'll try and sort the problem out over the phone. We have had a couple of emails bounced this morning. I've sent out all the lenders' criteria and terms. A couple have bounced, so we'll probably be in touch trying to get those over to you. If you use Microsoft Internet Explorer, you're going to have problems. I can guarantee it. Microsoft do not like companies using anything other than Teams, so they make it as difficult as possible. So it will not work, and you will have major problems. So switch to Chrome or Firefox if you possibly can. And we are depending on outsourced technology, so please bear with us. In recent months, we've had my computer shut itself down halfway through me speaking. And last month, we had a presenter who was actually upside down for the majority of delegates. So it looked like she was hanging from the ceiling. But she wasn't, I can assure you. If you have a question, go to the type your message in the bottom right corner, and we'll try to get to all the questions we have in the time available. Please keep them clean, obviously. Today's specialist, we have West One, Annette from West One, Jonathan from Allica, Tina from Selina, I'm dying to say that, and Andy from Catalyst. And these are the times they're on. So first of all, Annette from West One is on from 10:15 a.m. if I'm on time. And then we have Jonathan from Allica, Tina Wilson from Selina, and followed by my old friend Andy Keehner from Catalyst Property Finance. West One will be talking about buy-to-let, Allica about commercial, Selina about second charges, and Catalyst as bridging. So as always, we try and give a good mix of products so you're not hearing about the same product over and over and over again, like a recent seminar I went to from one of the financial press that did something in Watford, and I had to listen to 6 lenders all talking about buy-to-let and why they were the best, and I left after 5.5 presentations. So today's objective, as always, gain more knowledge on specialist finance. I'm going to be giving away some of my thoughts on some things that you could be doing, certainly to generate more business. Also, staying on the right side of regulation, very important these days, and just really some reasons why you do need to stay on the right side of regulation, because it might not seem important at times. I know it's a waste of time for a lot of people, but if it does go wrong, it can go badly wrong. Each presentation about 20 minutes, 10-minute Q&A afterwards. Speakers have also set themselves a series of questions, so please do not give them an easy ride. Please give them some questions that might actually get their brains ticking, because otherwise what tends to happen is that they'll give us questions that they've actually already covered in their presentation. So I also try and jot down a couple of questions that I can think of if I possibly can. But please don't be frightened to ask questions. And someone's actually said need some of those recipes. Yes, Serena, thank you very much. But please don't be frightened to ask questions. That's what they're here for. Is there anything you're thinking about? Don't worry about asking it. Don't think it's too daft to ask, because it won't be. Feedback and CPD, you'll be getting a feedback questionnaire immediately the show finishes, but there is a process you need to do. If you just close your browser down, you won't get the feedback questionnaire, and possibly also won't get the CPD certificate. So there is a process which I'll cover at the end of today's show. There's also questions within the feedback about what we can improve, what you actually wanted to see from the show, what you'd like to see in future shows. Also, very importantly, you're going to mark we want you to mark all the presenters, including myself, as to what you thought about them. That's also important, because if we get anybody, we've had a couple over the years that have been marked very low. It's just important that we know if they're not particularly popular, we're not, of course, going to invite them back again. But in the main, it's normally, obviously, our presenters are marked very highly. And once the feedback's been done and you receive that, you also get your CPD. Again, I'll cover that at the end of today's show. Right, I've cut down today's presentation only because I was starting feeling rough last night, so I thought I can't talk for too long. I can already feel my throat going and my nose running a little bit. But I want to cover this because I think this is one of the biggest opportunities that any of us will have in quite some time. This is going to be huge for us, and I'm going to show you different ways today where this can actually generate you stacks and stacks of business. You probably know now that EPC rules are changing in 2025, in that certainly from the start, investment property will have to have a rating of A, B, or C if a property is being let. Now, we've done a little bit of a survey on basically all mortgages and loans that we've run where we've obtained an EPC since 2016, and quite a high percentage are D&E. It really did surprise me. So there is a lot of people, a lot of landlords, especially, that will need to get those properties up to a certain standard. I won't read all of those because you've probably already read them yourself, and it is covered again in some stuff that I can send out to you. It was Tony Blair that said in 1996, education, 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 because I can guarantee most of your landlord clients will not have a clue about this until they go to re-rent a property in 2025 and then find they can't because of the rules. So just ensure that this is something that you put across to your clients as much as possible. I am thinking about coming up with a leaflet that you could use, a white label type leaflet that you could use, you brand yourself and send out to your customers, because I think it is going to be well worth it, because there's massive opportunities in this. And this is one of the best things I've seen. Shawbrook issued a white paper called the Confronting the EPC Challenge. Some of you have already requested this in the past. Understand if you don't need it, but if you would like a copy, just type EPC in the box below, in the message box, and that will be sent out to you this afternoon. It is excellent. It really is. I highly recommend you take a read, because some of the stats are quite scary. Completing existing business. This is just something that this is now so out of date, even though it was just over 3 months ago. It's unbelievable, because I can believe how many times rates have changed because of what's happened with inflation and base rates. But this will probably be even more drastic a drop, I would say, with the rate increases we've had. And we all know how busy it's been over the last month with lenders. And we've had one lender that's changed their rate 3 times in May alone, and is about to change them again. So massive drop in affordability on remortgage inquiries. I would say if you're not involved in second charges, you will not believe how much business you are missing. You really won't, because there is so much that we can do on a second charge you cannot do on a remortgage. We have, I believe it's 8 lenders now that do not have an income multiple. We have the other lenders who have income multiples, they'll go up to 6 times income rather than the usual 4.5. So there is massive opportunity. Debt consolidation is no issue. That a lot of debt consolidation is done within second charges. Loans for tax purposes, like to repay tax bills, anything of that nature that first charge lenders normally turn their nose up at, there are opportunities in the second charge market. Again, Tina from Selina will be covering some of this a little bit later in our presentation after our break. Again, I'm not going to read all of these things that come up. So retaining existing customers is also going to be incredibly important. And I'm probably be contacting some of you that do give us business on a regular basis to try and show you ways that you can not only retain existing customers, actually start generating decent levels of income from them, purely by something we can do as a joint venture. But this we find is the best way to stop lenders from nicking your business. And lenders are nicking business on a very regular basis. There are a few, we probably all come across it. Certainly in the specialist market, there are a few that really they're disgraceful. Quite simply, I can remember one that was phoning all our clients on the day of completion and saying, next time you want to borrow money, don't go to the broker, come to us direct, and you won't be charged a fee. Now, that's not right. That's not right at all. So when it comes to marketing permissions, you know that most clients will not complete the marketing permissions, get their okay to do this, but just tick do not contact, do not contact, do not contact, and then right across it, no marketing contact. We're aware that maybe a couple of lenders, when they get these in, are actually actually ticking the boxes so that contact can be made, because they get so much business. I recently come across a client that we did all the way back in 2012 on 2 buy-to-lets. Put it to a lender, a 5-year term. Unfortunately, at the time, we didn't have we didn't actually diarise at the time. We do now. I didn't diarise at the time when the fixed rate was coming to an end, or the term was coming to an end, and the lender contacted him and renewed it. Now, what annoyed me a little bit about that was he did apply to us first, and we put it to the lender, and they declined it. So they declined for us, but they did it themselves direct. It's now come up again, and this time we have got it diarised, and we are now helping him. But they have been contacting him and badgering him like mad to go direct. Again, very, very wrong. So just make sure you opt your client out now. Under GDPR, or to make sure you do not opt in. Under GDPR, lenders should then not be contacting. I think some don't take any notice of it, but still. And also, if you want to remain GDPR compliant, I've recently done this, and there's a very good reason in 2 slides why you should do this sort of stuff. We came up with this all the way back in 2018, copied and pasted from the ICO website, because we hadn't had any guidance whatsoever from anybody other than some daft bit of paper with 12 circles on it saying you must be compliant with GDPR, and not the reasons why, but actually telling you what you need to do. So I actually copied and pasted this into a document, did it myself, and then started issuing it to people who came to our mortgage roadshows that we used to have on the road. And now we issue them to anybody that wants one. So just type in GDPR 1 if you want the one that you should probably have done all the way back in 2018. You can then just tick all the boxes, sign it, backdate it if you want. It's entirely up to you, and then file it somewhere. And then if something does go wrong, you can show that you were compliant or you did your best to be compliant with GDPR. And then, of course, there's now an annual one that the ICO came out with. Again, didn't publicise it. So I just went into copy and paste again. And quite simply, I now do this every year, every May, just before the 25th. I just go through it. It takes me 2 minutes, literally 2 minutes. You asked me what any of the questions were on either of those two checklists, I wouldn't have a clue because I couldn't care less. But there's a very good reason why we do this. This is a very short story. This was a text message that I got all the way back in, as you can see, March 2015. This wasn't the first one. This was the second or third. I had a text one morning sitting in bed from somebody called themselves Mel Gibson, who said that they'd hacked our data and were basically holding me to ransom, and I had to pay them a ransom. Didn't specify how much, pay them a ransom in Bitcoin. I informed the police. I also had to inform the ICO and the FCA, who were both rubbing their hands together, thinking, "Oh, fine time, great, more money into the coffers to pay for another work of art on the ballroom wall." So I informed the police. It took them probably about 24 hours to get involved. And when they did get involved, you wouldn't believe the hell I went through. I was actually being watched by the police because they thought I was actually being followed by hackers or somebody hackers. And then they realized it was actually potentially somebody that I employed. They then came into my office one day and arrested somebody that they thought it was, and it wasn't. The poor sod was a victim of circumstance. But that's a much longer story. But they didn't actually eventually find out who it was, but they couldn't bring charges. They didn't have enough evidence. So just be very, very careful, because if you are hacked and you do not have anything to show that you have been compliant with GDPR, and this is way before GDPR, obviously, but you don't have anything, then if the FCA and the ICO don't take you to the cleaners, the claims management companies will. Now, mine was an internal problem with an ex-member of staff. If yours is an external problem, it could put you out of business. Okay, first presentation's about to start. Get yourself comfortable, get yourself a drink. I just need to probably stay silent for 10 seconds, and then the first presentation will appear. And there it is. Right, so first one is our first speaker, Annette Tilbury from West One, who has been in the industry for a long, long time, and you'll probably realise how long when you see a couple of lenders she worked for previously. I hope Annette's in the room. Yes, she is in the room. She's about to appear as a speaker, he says, crossing his fingers, hoping nothing goes wrong this time. Okay, you should have received this morning the West One buy-to-let product guide. Now, we have package status with West One for their buy-to-let product. In fact, we have package status across the board, across all their products. So refer to that if you need to. That just gives you an idea of the existing terms, which is probably going to be out of date in about 3 days' time because of the way things are going. But that will give you an idea of exactly what they got. Refer to that if you wish. A little bit on Annette. Annette is passionate about this specialist area of the market and uses her knowledge and experience to develop key relationships, looking after sales and distribution for buy-to-let mortgages. Annette loves helping people. It gives her a real buzz when she manages to get a difficult case through and make a difference. I'm now going to talk slower because she's still not appeared in the room. Prior to joining West One, Annette worked at Foundation, doing a similar role, and CHL Mortgages, undertaking a variety of roles within sales, asset management and underwriting, building new teams, and expanding her knowledge of residential and buy-to-let. Prior to Capital Home Loans, she worked for the Mortgage Corporation, and there's a name from the past for those who have been in the industry a few years, and Alliance and Leicester. Dealing with residential mortgages, and she's just about to appear, so I can stop panicking. I'm hoping she's about to appear. I can see her initials, and now I can see Annette. Annette, can you hear?
Yeah, I can. I don't know what the problem is. I've had a few connections because while you were talking, it dropped off, but it seems to be okay now.
You're here, great. Okay, well, I'm about to pass you over. But just one last thing. Annette's interesting fact: Annette adores going on safari and photography. So I won't cover too much on that because that's pretty much self-explanatory. I don't have to go on safari because the amount of wild animals I find in my back garden and my front garden at the moment that come to die is getting beyond the joke. So I will pass you over to Annette, and I will see you in about 20 minutes.
Thanks, everyone. As Tony mentioned, I'm Annette Tilbury. I'm the National Account Manager for West One Loans. I'm just going to go over some different property types that we're finding landlords are using to maximise rental income. So just shout out any questions as we go along. I will briefly touch on West One for people that haven't used us or don't really know us, and then I'll touch on various different property types. So in 2005, West One were established. We've got a very unique approach to credit, and we're the UK's fastest growing specialist lender. We have bespoke technology solutions to support swift decisions. And I'm pleased to say we've got an experienced underwriting team, and they are not reliant on credit scoring. They will make individual decisions on the cases that they're assessing. So let's just talk about some of the different property types. I'm sure you're all aware everybody's doing standard properties, a lot of people touching on commercial, but we're certainly getting a large number of referrals where cases have been declined by other lenders. So if you do get a property that's above or around commercial, then certainly it's one to consider sending across to us. We'll go over it in a bit more detail in a moment. HMOs and multi-unit blocks, we're finding that we've got massive growth with those. And new builds, we're getting a lot of new builds because we go to, we don't have a limit on the maximum number of stories, etc. And we'll look at commercial as well on the ground floor. We get a lot of new builds, and of course the ever popular holiday lets. I did think that might have calmed down a little bit by now, but we're seeing a lot of applications for holiday lets, so we'll touch on those as well. So properties above or near to commercial, we always recommend that they're referred to us so that we can do an agreement in principle for you. So please send them across to Specialist Hub and they'll refer them on to us. But as a very rough guide, we will generally look at above offices, banks, building societies, that sort of thing, 75%. If it's above hairdressers, dry cleaners, where perhaps there's chemicals, they're open slightly longer hours, etc., we'll be perhaps looking at 70%. And if it's above a food outlet or next to a pub, something like that, then we will be looking at 65%. But as I say, you do need to refer them to us. They're always subject to a satisfactory valuation. And we do have our own in-house valuation team that we can refer things to. And basically, they will be able to assess comparable evidence. They'll be able to provide a lot more information than we would be able to see or find, and let us know what the maximum loan to value will be. And some of the areas to watch out for. So if you've got a flat on the high street where perhaps access isn't off the high street, it's at the rear and there's a metal staircase to gain access, valuers don't tend to like that, and we'll quite often get negative comments regarding that. Also, if the property is in a very commercial area, so busy roads surrounding the property, railway lines, anything like that, that might cause there to be a restriction on saleability, it's just being aware of that. And obviously, if we refer that to our in-house valuers, they'll take that into account. We don't lend on properties that are next to nightclubs or above nightclubs or funeral parlours. They're not keen on graveyards, basically anything that you would think, I wouldn't want to live there, then it's likely that it's going to have a negative saleability. But please do refer them. A bit like the metal staircase that I mentioned, it doesn't mean that we wouldn't necessarily be able to lend on that flat, but it may be that we have to restrict the loan to value slightly. The property also needs to have demand for owner occupation. So we get a lot of referrals where the block is said to appeal to investors. We haven't got a problem when it appeals to investors, provided there is interest by owner occupiers as well. So please bear that in mind, that if there's no sales other than investors, then that would be an issue for us. Another area where we're seeing, unfortunately, a bit more of an issue is with ground rent and sometimes service charges, but in particular ground rent. If it exceeds outside London, the 0.1 and capped at 250, inside London it's capped at 1,000. We also have the guidance that it shouldn't increase any more recently than every 10 years and in line with RPI. But what we're actually seeing is where people have purchased properties, it fitted that criteria with regard to the 250 and the 0.1. However, the ground rent has been increasing by doubling every 5 years, and it's now exceeded those limits, and obviously is considered onerous, and it wouldn't be something that we can accept. And when those limits have been exceeded, it does mean that we don't need to be informed as a lender that if that ground rent hasn't been paid, they're in breach. So obviously, as you can imagine, that would be a serious issue for both the borrower and us as a lender. So it's certainly one to get that information up front so we can check and make sure and not waste anyone's time on it. HMO properties, HMOs and multi-unit blocks, we're seeing that there's a strong long-term prospects for capital appreciation for these type of properties. Certainly with the changes with relationships, and you hear all the time that the numbers of divorces are going up and more individuals looking for accommodation, then there's more need for affordable accommodation. People can't necessarily afford to rent a single flat to themselves. And easing of lockdown, we've seen great demand, a lack of properties for rental and even for sale now, I think, where people are looking to use buy-to-lets to increase pension income, etc. Just to be able to find a property and not be outbid seems to be quite challenging at the moment. Changes with the HMO definition, I think they've settled down and most people are aware of that now. Along with the licensing and planning, landlords are aware they need to check with the local authority and the area that the property's in, that they have what licensing is required, etc. And obviously there's been a number of tax changes. Again, there was a lot of talk that, oh, you know, people are just pull out of the buy-to-let market and it won't be so popular. But clearly we haven't seen that at all. And as with the multi-unit freehold blocks, there's less exposure of rental voids and higher rental yields than traditional properties if you've just got a single let property as opposed to a HMO or multi-unit block. Obviously, they're going to deliver a much better return for you. Strong market demand, as I say, it just seems to be a growing market. We're definitely getting more and more inquiries. And with the multi-unit freehold blocks, there isn't the same licensing requirements that need to be checked out, so it makes it a little bit easier for applicants. So we're quite happy to look at first-time landlords for HMOs, multi-unit blocks and holiday lets. And HMOs as part of a multi-unit block are acceptable. Those sort of hybrid type properties seem to be becoming more and more common. We will also look at a HMO or multi-unit block where it's above commercial or next to commercial. As I mentioned before, they always need to be referred for agreement in principle. And necessary license needs to be in place when it's a remortgage, but when it's a purchase, then we would make it a condition of the offer that they apply for it. Things to watch out for on HMOs and multi-unit blocks. If you've got a large HMO, which is 7 or more bedrooms, then we do need AIP, and we will confirm what the valuation cost is for 7 or more bedroom HMO. And if you've got any larger blocks, whether it's a multi-unit or a HMO, more than 10 units or 10 bedrooms, then again, they would need to be referred to us for agreement in principle, and we refer those to our valuation team. Already mentioned flats next door around commercial, they need to be referred to us. And the other area where there seems to be a lot of inquiries is properties with annexes. People seem to have decided that that's another way of generating a greater return. So the key thing is actually understanding, is that annex like a granny annex, which is part of the property access through the house, or has it got its own separate access, its own separate utilities, council tax, etc. And then once you've got that information, if you refer it all across to us with the full address, we can have a look at that. If it is a case where it is separate access, its own utilities, etc., you've got the house and the annex, we would normally class that as a multi-unit freehold block with 2 units, just so that you're aware. New builds, again, really strong area for us, particularly because we don't have a maximum number of stories to the block. So we will look at the high rise and also allowing commercial on the ground floor. We do require a lift if there's 5 stories or more. Generally, that's not an issue at all. And we class new build as if it's built or converted within the last 12 months. And we don't take into account any new build premium. And what I mean by that is when the valuation's carried out, the valuer will provide comparable evidence, and that comparable evidence will effectively be second-hand valuations. So they will base the value not on any new build premium being there. Things to watch out for with ourselves, we don't lend off plans. So if somebody comes to you and says this property is going to be ready next year, that wouldn't be one for us. We actually want the valuer to go out and provide a bricks and mortar valuation. So yeah, if they're near completion, then we can help with those. But if it's a long way off, then that would be an issue for us. Always best to refer new builds just to check the exposure limits to make sure we haven't already exceeded the maximum in the block, particularly for these high rise and where there's commercial, because a lot of lenders don't seem so keen on those. We do get a lot, so it's best to check that out. We've already mentioned the issue with ground rent and service charges. If you do have a block where there's commercial on the ground floor and sometimes there's a concierge gym, things like that, then the service charges can be that bit higher to reflect the cost of those. But again, that's something that we would just refer to our in-house valuers, make sure they're comfortable that it isn't excessive, so we've got an idea up front. We will also always require satisfactory planning, building regulations, and I'm sure we all wish we hadn't heard of the EWS1s, but we do require an EWS1 if the property has got cladding. And obviously a new build warranty, a suitable new build warranty would need to be in place as well. So that's our new builds. So holiday lets. Holiday lets have been massive for us. I've kept thinking they will die down unless people will be doing them, but they still seem to be ever popular. I think with the number of holiday bookings in the UK still on the increase and surpassing obviously pre-pandemic levels, there is a much more increased appreciation for UK holidays. And also it's a more sustainable tourism with a lower carbon footprint, and a lot of people that appeals to them, and it can be a more multi-generational. It's much easier to put Gran in the car and take her to a holiday in the UK than maybe her try and fly for 4 or 5 hours somewhere. And obviously with holiday lets, it's seen as a very good investment. There's a much greater return, even if it's just for those peak holiday months of the summer. We do have a number of landlords that will do an AST over the winter months, and then they'll just maximise on their rental return during the summer months when they can get those holiday let bookings very easily. And it's another opportunity for landlords to diversify their portfolio. And we have seen a big increase in that, where landlords would traditionally do your single let, buy to let, and that would be it. And now we're seeing they've got multi-unit blocks, HMOs. They're even getting involved in converting, where they're creating 2 units out of 1, etc. And holiday lets adds that another dimension to their portfolio. We do also accept your multi-unit freehold blocks on holiday lets, which a lot of lenders aren't keen on. And again, it's just another way of them creating a greater rental return than if it's just a single property. So holiday lets still massive for us. And finally, I'm just going to touch on some of our criteria for you. So we have a minimum term of 5 years, a maximum term of 25 years, minimum age 21, and maximum age is 80 on application. We also don't have a minimum income or minimum period of employment or self-employment. So if you do have somebody that's recently changed jobs or they've gone self-employed, so they haven't got an SA 302 because they haven't been doing it long enough, then we require them to confirm what their income level is. But we don't have that minimum period like some lenders. So if they've just started a new job, haven't passed probation, that's not an issue for us. The thing to remember is the cases are being individually assessed by our underwriters. So if they need some extra comfort to see level of savings to cover rental voids or something like that, then that's something they may well ask for, particularly if they are a first-time landlord. That might be something they're asking for. We do accept family gifted deposits and gifted equity. So particularly if you had a first-time landlord who is getting all of the gifted deposit, then that would be a scenario when they would want to see that they've got some savings to cover rental voids. But the good thing with the gifted deposit is we don't have a restriction on the maximum that can be gifted. We don't have a requirement that the applicant needs to put a certain amount in themselves. So yeah, that's quite a popular one for us. Consumer buy-to-let, not an issue for us. We do lots of those, and also let to buy. And we're seeing quite a big increase in people looking to keep their existing resi and move on to a new residential. The key thing to remember with ourselves is that we will do a let to buy where they're doing a simultaneous completion on a new residential, but we won't turn someone's current residential home into a buy-to-let. If they're just moving in with family or friends, that wouldn't be acceptable. So provided they've got that new resi purchase, or it could be they're moving in with partner and being added to their mortgage, that would be acceptable to us as well. And finally, just touching on some of our key criteria. So we have a portfolio lending product now that allows borrowers who fit our W1, which is for clean credit profile. They are allowed a CCJ or default up to £500. It doesn't need to be satisfied, but generally quite clean clients. So if they fit that profile, we can go up to 15 million on the portfolio product. 10 million is the normal maximum on our core range. And we'll also look up to 2 million at 75% on a single asset. If they want more than 2 million, then we can look to go between 2 and 4 million at 65%. But you would need to refer the full details of the property across, and we would do an agreement in principle for you. We've also increased our leasehold block exposure. So where we go and we generally say we'll go up to 10 units in a multi-unit freehold block, and we can consider more by referral. Now we can go up to long leaseholds in a single block up to 20, even if there's only 20 in the block, so 100% exposure. So again, ones that you do need to refer to us, and we can check and say if we're comfortable with taking the entire block and what the value is and loan, etc. We've maintained fantastic turnaround times. We've got 48-hour turnarounds for applications, post, etc. So that is a key strength of ourselves. We've got a very strong underwriting team that work very hard to keep everything within service standard. And as I mentioned, each case is assessed in its own merits. We don't have a credit score, but we do carry out a credit cert by Equifax. So we need to be able to find payment profiles, etc. on there. But first-time landlords, not a problem. They don't need any experience to do a HMO, multi-unit block or holiday lets, even if it's a 10-bedroom HMO. That's not an issue for us. Ex-local authority flats, again, we get a lot of these because we will look at them with deck access, and we're generally looking for a minimum of 40% private ownership. So they can check that with the local authority. It's a very rough guide. You can check on the website Street Check. There's a property section, and if you look at that, it actually breaks down what the types of properties in the road are and what the percentage of owner occupiers are, whether, if they are owner occupiers, whether it's mortgaged or not. It goes into quite a lot of detail, so it's well worth a look at that. Corporate lets, another real strength of ourselves. We will go up to 5 years. We accept DSS, student lets, and also vulnerable tenants. And they're the sort of ones that we've been doing are charity, where perhaps they're putting in vulnerable tenants where they've been perhaps previous drug addicts. Sometimes it's foster children that have come of age, can't be fostered anymore, but need to be housed, that sort of thing. Provided the tenants do not need 24/7 care, then we can look at that on a corporate let basis up to a 5-year term. We do require a break clause to be enforceable from inception, that the landlord can serve notice at 6 months. So that's as a minimum. Sometimes we see the agreements, for example, Serco, who put a lot of asylum seekers in properties, where they might ask for a 7-year term and say that notice can't be served for the first 2 years of the agreement, or a condition like that. We just go back and say that's not acceptable. Maximum 5 years term, we need the 6-month break clause, and they normally just amend that. It's not an issue. Expats, another real strong area for us. We do lend in within the EEA as standard policy. Any outside the EEA does need to be referred, but if it's on the warning list of the FATF, as a country that's on the warning list, we wouldn't be able to accept them. So it is worth checking that as well. Day one remortgages, and we will base our lending on the current value where they've done works to the property and enhanced the value, or it could be they've done a lease extension and that's enhanced the value, so we can base our lending on the enhanced figure. And as I mentioned, default CCJs below £500, they're ignored. Also, if you have got a client that's made a late mortgage payment, and that means paid within 30 days of the due date, then we don't class that as arrears, we just ignore that. So if you have got a credit report showing one down, but the client says, oh yeah, I paid that within 10 days, that situation, then we can override our system for you. So thanks for your time, and hopefully we can help with some questions.
We certainly can. They've been coming in thick and fast, the questions. Annette says thank you. Martin Myers, good morning, Martin. Hope you're well, has asked, if it is one utility and one access with no planning, is this acceptable? One utility and one access to the property with no planning, is this acceptable?
We would still need the necessary planning, yeah. And one utility, that implies that there's another utility that will be shared. So because you would need water, you would need power, so you would expect at least there to be two utilities, water and so it sounds like they've got partially shared. And
I'm not sure at what stage that question was asked, so maybe Martin, if you could just clarify. We'll go on to the next one. He's actually asked another question as well. But Jonathan Sherwood, morning, Jonathan. I hope you're well too. Has said, so you allow landlords to let on an AST and holiday let at on the same product?
Yes, so on the holiday let product, we do not require an AST. That's the core difference between that and a normal range, because clearly if you're holiday letting, you're not going to have an AST. But what we found is in particular areas where there's not so much demand over the winter months, that they will tend to do an AST over the winter. And don't forget, we're always basing our lending on the AST figure. So yes, that's fine if they do 6 months holiday letting, 6 month AST, then yeah.
Okay, Ketan has asked, morning Ketan, hope you're well too. So just to confirm, for first time landlords, they can borrow from MUFB, multi-unit freehold block, and holiday lets. Is there a minimum income they need or a cap on LTV?
No cap and no minimum income. But like I mentioned, the underwriter's got to feel comfortable with the deal. So, if they didn't have a particularly high income, then the questions would be, well, where's the deposit coming from? If it's gifted deposit, something like that, then they would be looking for savings to cover rental voids. So
another question from Martin. Will you accept UK expats living and working in America?
Yes, we can look at America. It needs to be right by referral. Key thing is for expats, they need to own at least one buy-to-let in the UK already. So what we tend to find, it's generally what was their home, they've converted that into a buy-to-let, that's fine. But if, for example, they'd sold it, didn't own any property in the UK, but suddenly thought, oh, we want to have that buy-to-let over there now, we need that mortgage track record, because the underwriters don't have a scoring, and obviously if they're not in the country, they wouldn't have a good score anyway. So yeah, provided they've got an existing buy-to-let and they can see a mortgage payment profile on it.
Okay, 3 more questions, then we're going to have to go because we're a little bit over time. Serena has asked, hi Serena, is your day one remortgage literally day one, or does the TR1 need to be registered already?
TR1, they would need to get the confirmation that that is registered. So I think we've had some cases where we've worked on it and the solicitor that dealt with the purchase has confirmed the purchase, etc. But they would look for that to be verified.
Okay, Ketan has asked, would you lend to someone on a tier 1 visa?
No, not tier 1. Unfortunately, they need indefinite leave to remain with us.
Okay, final question from Femi. Yeah, hi Femi, hope you're well too. What about a bed sit with less than 30 square meters total floor area?
Right, so there's a couple of things here. So less than 30 square meters we can look at. Generally, we're looking at 25 or above. So, if you're talking about a multi-unit freehold block and you said to me, we've got 10 units, most of them are over 30, but I've got one that's 27 and one that's 24. That's the sort of thing we would make an exception on because it's a multi-unit freehold block. If you came to me and said, we've got an individual flat, 24 square meters, I'll be saying, no, it's too small. It's not over 25. But as one-off sort of part of a multi-unit block, we can make an exception. So really 25 is your guide. If it's part of a multi-unit block, 20 is the absolute bare minimum, and I'm literally talking about one of the units being that size. If you said I've got 5 of them that size, we wouldn't entertain that. But bed sits, it depends on the type of accommodation, because what we're seeing in HMOs particularly is that the rooms have kitchenettes in rather than a shared kitchen. So we've had a number of those that have been referred to the in-house valuers and agreed. So I would say it's case by case. So just get the property details referred across. But we have done both of those bed sit scenarios and less than 30 square meters.
Okay, Femi, stay tuned, because when I speak later, I'm going to be talking about exactly this, and I've got a solution for you if West One can't do it. So thank you, Annette, very, very much indeed. Excellent as always. We will see you very soon in the office now that we're all accepting visits again. So look forward to it. Thanks again. Simon will remove you from as a speaker.
Yeah.
We don't want you or any of today's speakers actually closing down the entire show, as
No,
someone
I
actually tried
won't
to do
do
once.
that, I promise.
So someone will take you out and the next person will come on, but thanks again.
Thanks a lot. Cheers.
Okay, our next speaker, who is not almost in the room, I believe, so I'm going to talk very, very slowly just in case he doesn't appear. Okay, so we've got Jonathan Prince from Allica Bank, an old friend of the show. He's done a fair few of these now. I'm going to say quite a few, a fair few since we went virtual rather than the physical ones. Jonathan's there. Can you hear us?
I can indeed. Hello.
Now, how are you?
Yeah, very well, thanks, Tony. You?
Yeah, all right. Other than this crappy cold that I got, other than that, so I'm trying not to sneeze on camera at the moment, but or sniff. So I will crack on because we're a little bit behind time. So okay, so you should have received this in on your email this morning, just to give you a little bit of an idea about what Allica do. So a little bit about Jonathan, working in commercial finance for the last 9 years, all of which have been spent with small challenger banks. He has largely worked in credit functions, which has given him a strong understanding of business risk. He moved into relationship management at the start of 2020. And his interesting fact, I think personally he's got a stamp duty addiction. I know he's actually got another explanation. But Jonathan has moved house 26 times in 31 years. I couldn't think of anything worse. I really couldn't. The last time I moved was 15 years ago, and it took me about 2 years to recover. I'm still unpacking, it would seem, in some cases. So, Jonathan, I'm going to pass straight over to you, and I will see you in about 20 minutes.
Great, thanks, Tony. And I'll try and talk slightly quicker to make up some of that time that we've lost. So, firstly, good morning, everyone. As Tony said, I'm Jonathan. I'm the Senior Commercial Manager at Allica. And I'm going to talk you through basically a little bit about the bank. Given we're a relatively new business, there's still some people that may not have come across us, and those that have might not know the detail behind us. So a little bit of an overview of the bank, and then I'm going to talk you briefly through our products and processes, talk a little bit about some of the things we've got coming down the track, and then leave some time for some questions at the end. So jumping straight in, Allica launched at the end of 2020, so September 2020, so we've been trading for a couple of years, launched into general recession, general election, pandemic, now a recession, so a little bit of a turbulent first couple of years for us, but actually it's been really, really good for us in some ways, in that it's allowed us to really get our name out in the market, where a lot of lenders were forced to step back from the market, whether it was through to private funders having a lack of cash to lend out, whether it was down to bigger banks having to focus on existing loans rather than new. It allowed us to really keep our best foot forward and continue to lend to new trading businesses. That was really, like I say, really great for us from a profile perspective. We managed to pick up quite a nice handful of awards in our first couple of years, having won 3 at the NACFB in our first year and 5 in the second year. And we were named by the Times as one of the top 20 fintech companies. So getting some really nice recognition on that there. And just to sort of talk you through some of our highlights from the last 12 months, we were fortunate to be able to purchase AIB's UK SME loan book last year. We've actually completed on the first tranche of that, with the second due to complete shortly. And basically what that has meant is we've transferred over £600 million of loans from AIB to Allica. And we've done some quite extensive fundraising in the background to enable us to do that. So it's been quite a successful year for us financially. And we've hit a few milestones recently as well. So we've raised over £1 billion of deposits. We're due to hit £1 billion of book lending in the next few weeks, and another £1 billion should be offering £1 billion in committed new lending offers this year. So moving swiftly on. We recently got the results of our broker survey. So we tend to do these on a quarterly or 4-monthly basis. And we're really pleased to say that those results have gone up every single time we've surveyed. So from our most recent survey, we had 89% of commercial mortgage brokers rate their overall experience with us as excellent or good. And over half of those said excellent. And very similar numbers from our asset finance team, albeit they did pip us by 3% over on the excellent and good. We're still analysing the results of those, but do keep an eye on LinkedIn because we'll definitely be shouting about some of the outcomes of that. And again, finally, just to touch on some of the awards. So last year we were very lucky to pick up 4 awards at the NACFB, as well as a highly commended. As well as winning a few categories across Bridging Commercial, Money Facts, and the British Business Bank Awards. So yeah, good medal season for us, so to speak. And that's, really thank you to the broker community for believing in us and backing us when we were that new kid on the block a couple of years ago. So I'm now going to jump straight into the exciting bit, which is the products. Essentially, as a lender, we have 2 core product offerings, both in the commercial space. The first is for commercial owner-occupiers, so that is businesses looking to acquire or refinance their trading premises. And the second is investment, which is commercial and semi-commercial investment. We don't do any sort of pure residential buy-to-let or anything like that. Borrower types, we will lend to limited companies, LLPs, partnerships, and sole traders. And within that, we do have the ability to lend to SPVs and NewCos that haven't yet been incorporated, which is something we're starting to see a lot more of, particularly in the owner-occupied space where they're wishing to keep the asset separate from the business. Our loan sizes are from 150,000 up to 5 million. And they are available on committed terms up to 25 years. So for us, that means it is a 25-year committed loan. It's not a 5-year loan with a 25-year repayment profile, for example. We offer both variable and fixed rate products, and I'll come on to those shortly. One thing that really sets us aside from a lot of other lenders is the only security we take as standard on every single deal is a first legal charge over the property. Things like debentures and personal guarantees are very much case by case. So we're only taking those where we feel that there's a real weakness or risk that we perhaps need to mitigate. But as standard, it is just the first legal charge over the property. ERCs vary depending on whether we are looking at a fixed rate or a variable. For a variable, it is 3% in the first 5 years. And for our fixed rates, it's a decreasing basis over the first 5 years from 5% to 1%. So moving into the owner-occupied product, we will lend to businesses and properties based in England, Scotland and Wales. We don't do anything outside of sort of mainland Britain at the moment. The repayment type we offer is a capital and interest repayment, so fully amortizing through the term. But what we will allow is for the first 2 years to be on a capital repayment holiday, which is essentially 2-year interest only period at the start of the loan. That is very much a product feature of our loan. It's not something that you have to qualify for or anything like that. It's simply a case of, if the business would like a bit of additional cash flow in the first couple of years, as long as the affordability still works over the remaining 23 years, then that's absolutely fine. We've seen this really useful for a lot of businesses in retail, hospitality, where, they've made their recovery from the pandemic, but they're still very much, trying to build up their cash flow and perhaps build a little bit more of a cash reserve that they might have had to use through the pandemic. and the 2 years interest only is really helpful there. Margin range is typically 4.5 to 5.85 plus base rate, and our fixed rates are between 6 and 6.24% all in. One thing to call out here is if you've got an owner occupier which can demonstrate 2 times debt service cover, then we will allow them to borrow up to a maximum of 60% LTV at 3.5% plus base rate. And on all of our rates, both variable and fixed, we offer a 0.25% reduction for 750,000 or more. Debt service cover, we ask for 130% using adjusted EBITDA. What that is essentially a few additions and deductions made to the net profit figure to allow us to get closer to a true cash position. But if you have any questions on that, Tony and the team are very much familiar with how we do that. So by all means, run any deals past them and they'll be able to help out. So moving on to our commercial and semi-commercial investment, we offer 2 different product options here. The first is a capital and interest, and we also offer an interest only. That is currently only on our variable rate product. And that is for up to 10 years. So we still have the minimum of 5 years, but up to 10 as a maximum. And we do our interest only at exactly the same rates and LTVs as our capital and interest. There's no reduced LTVs or higher interest rates or anything like that. The only thing we do ask is that it would service using the gross rent over a full 25-year amortizing period rather than just an interest cover. So margin ranges, we publish all of our margins and fixed rates in the commercial and semi-commercial space, which is that table at the bottom there. And those on the left are the margin, which you need to add base rate to, and those on the right are fixed. So obviously all in interest rates. We charge the interest based on 2 things for commercial or semi-commercial. The first is how commercial or residential that property is, and the second is the loan to value. So what you'll see there is 20 to 50% residential and 51 to 80% residential. That is based on the floor space of the property rather than any rental income or something like that. So, you know, really, if you're looking at a shop with 2 flats above, you're going to be in the 51 to 80%. If you're looking at a shop with 1 flat above and they're both the same footprint, that's going to be the 20 to 50. And in terms of debt service cover, we look for 135% cover, and that is just using the gross rent. So there's no net rent deductions made or anything like that. For our fixed rates, that is 135% on the fixed rate. For the variable rates, we do add 1% on as a stress test, and that is basically just to ensure that the loan will still be affordable in the event of future base rate rises. So moving on to the property types that we will lend on, what I would say is this is not an exhaustive list. We will consider most asset classes. There's a few things we absolutely won't do, which I'll come on to shortly. But you know, if you're looking at a transaction and it's not something that's on one of these lists, by all means, still get in touch with Tony or Joe, and they will absolutely be able to pick that up with us and guide you through it. So the properties we split into 2 separate areas. The first is your standard property type, where we're just lending against a normal vacant possession, bricks and mortar value. The second is properties which include inherent goodwill in the property value. So that's where you've got, say, a pub or a restaurant. If that place has got a particularly good reputation and is trading well, there's going to be a premium over and above the property value that somebody is willing to pay for that. And we do lend against that valuation. The other thing to call out here is for owner occupiers. Again, if they can demonstrate 2 times debt service cover from the most recent year's accounts, we will consider up to 80% of that vacant possession value on standard property types. And really that's just reflecting the creditworthiness of those borrowers. Now, we'd look to see that 2 times debt service cover is sustainable. So, for example, if we're looking at a 3-year account period, 2 years are just scraping past it, and the 3rd year is giving us the 2 times, then we'd have to apply a layer of common sense over that and try and understand why the profitability is increased. But that is available on most types. And irrespective of that, even if they're not showing the 2 times debt service cover, for most asset types, we're up to 75% of the vacant possession value as a maximum. For the trading property types on the right-hand side, where they are owner-occupied, we're typically up to either 70 or 80% of the bricks and mortar vacant possession value, and up to a maximum of 70% of that market trading value. So as I say, there's a few things that we won't do. The absolute no's for us are anything in the arms and weapons sector, anything to do with adult entertainment, gambling, animal testing, or community sports clubs, so local football clubs, rugby clubs, cricket clubs, whatever it may be. The one caveat to that is for gambling. Whilst we wouldn't lend directly to a bookmaker or something like that, we would lend where you've got an investment property and you might have somebody like Ladbrokes in as a tenant. That is acceptable to us, but we just wouldn't lend to that business. We don't have any appetite also for any lending to religious buildings, and that is more the use of the building rather than how it looks. So something like a converted chapel that's being used as offices, that's absolutely fine, but we wouldn't lend to anything that is currently being used as a place of worship. Likewise, nightclubs we wouldn't consider standalone. We have had a couple of cases where we're looking at 5, 6, 7 properties in a parade. One of them happens to be a nightclub or late night bar. We will lend on that. But if it was just a nightclub or perhaps a nightclub and one other unit, then that is going to be outside of our appetite. And we won't lend on anything that is used for a residential use. So park homes and caravan parks. What I would say is absolutely have a conversation with us if that is a holiday letting business. But if it is residential, there's people living on site, then that wouldn't be one for us. There's plenty of things, like I say, that aren't covered on either the yes or no list. We have done some quite quirky stuff. I think I can think of a deal we've done recently on a polo club, for example, that we managed to get through. We've done some quite unusual asset classes. So by all means, if it's not in one of these 2 lists, do get in touch and we'll be able to advise on that. We also offer a healthcare product, and this is for lending against care homes for elderly and dementia care. We don't currently do any specialist care, so learning disability, children's homes, things like that are still very much outside of our appetite. But care homes we will consider. The criteria is slightly different here in that the loan size is from 500,000 to 5 million, but we do cap that at a maximum of 5 times EBITDA. So that's earnings before interest, tax, depreciation and amortization. We will lend up to 70% of the market value and 120% of the vacant possession value. The interest rate very much dependent on where you fall in the loan against bricks and mortar value. The term is up to 25 years and exactly the same committed on a full term basis. We do only offer capital and interest repayment on care homes. And we do look for a minimum debt service cover of 150%. And that is using CFAD's cash flow available for debt service. It's a slightly different calculation, which is a little more complex, but we do have specialist relationship managers that can help guide through that process. So don't be put off by some of the more unusual requirements here, because we do have specialists that can assist. In terms of general appetite on healthcare, we usually look for experienced operators. We will consider a first-time buyer, but we would look for experience within that business. So that is usually the care home manager staying on, or very, very close experience from the actual applicant. We look for our properties to have a minimum of 20 rooms, and they must be rated at least good with the Care Quality Commission. And we do look for 85% occupancy over the last 12 months. The pricing table shown at the bottom, that is very, very shortly due to be updated. So again, do keep an eye out because we will be offering some more competitive pricing on the care home product. So in terms of fees and commission, we charge a 2% arrangement fee, and we pay 1.5% of that to specialist. We ask for a fee of £5 to be paid on acceptance of formal offer. So it's not an application fee. It's very much once the customer has full list of terms and the offer in their hand. And that is refunded on completion. So that is basically just a cost to cover our administration expense in the event that that deal doesn't complete. And valuation and legals, as you'd expect, we use third parties for those. We do have a fee guide on our website, but of course, because we're dealing with commercial property, they're not always rock solid, but we will always provide a quote and an estimate at application stage. So in terms of information that you'll need, we try and keep this as slick and streamlined as possible, but also we look for as much information to be provided as possible up front so that we can make an easy decision and keep those conditions in the offer to a minimum. So really all we're looking for is basic information about the company, some affordability and the details of the property. That is to include tenant details if it is an investment transaction. And then for a full application, we're looking for essentially the financials to then accompany that. So 2 years accounts plus MI, 3 months business bank statements, an asset liability income and expenditure statement, plus a property schedule if it's an investor, and some commentary on the background of the business and the proposal itself. In terms of applications, again, pick up with Tony and Joe or anyone at Specialist. They will very much be able to guide on our appetite. We've been working with them for a number of years now. They're now quite familiar with what we do and how we do it. And yeah, any questions, please do fire away.
Jonathan, thank you very much. Great as always, and great to have a commercial lender that's actually looking to lend as well. We all know there's lenders out there who sometimes pretend they want to lend in the commercial space, but it doesn't often materialise. But Allica certainly do. They're very, very proactive in this, and also were very proactive throughout lockdown as well, where others pulled away and shut up shop. They were actively lending. So we got one question that's been asked, which I think I already know the answer to, but I'm going to let you answer it. So if a tenant defaults and there is a change of tenancy during the mortgage term, can the interest payments be halted for some time? If so, how long can that be for?
We don't have a set policy on that sort of thing. Now, anything like that where you've got a borrower struggling to make repayments, that, you know, what I would always say is get in touch with us and we will always consider forbearance. You know, we're not in the market to just, you know, take properties out from under people's feet without need. So we would absolutely work with the customer to find the best solution there as to how we can maintain that loan rather than call it in.
Okay, I'm going to ask one because one of these you've already covered, but one of the questions you set yourself is: in light of recent pressures in the economy, what adjustments are you making when considering a case?
So we're trying to be really flexible on this, and obviously, as everyone will be aware from reading the news and through their own personal finances, the two big increases that we're seeing at the moment are motoring costs with petrol and diesel prices, and of course energy costs. Now, we're not doing anything in terms of general inflation because we're very much believers in savvy business people will, you know, adjust their costs to their customers in order to make sure that they're maintaining a decent margin. But what we are doing at the moment is adding 50% onto any motoring expenses to account for higher fuel costs, and we're taking the energy costs and multiplying them by 3. As a stress test. Now, for commercial businesses, we are expecting increases of between 5 and 7 times on energy costs, but equally we do appreciate that some, if not all of that cost will be passed on through their turnover. So we're just doing a 3 times stress test on that. But other than that, we're not making any adjustments at all.
Jonathan, tremendous. Thank you very much as always.
Not at all.
Simon will remove you as a speaker, but not from the room, obviously. Everyone, what we'll do is we're around schedule, but I'd like to come back by 11:20 if we can, purely so we can then crack on with the next 2 speakers and also my bit at the end, which I have cut down today by a fair bit. But if we can get back by 11:20, so that is about 5.5 minutes. Jonathan, thank you once again.
Thanks,
See you
Tony.
soon. And everyone, see you in 5 odd minutes. Welcome back, everyone. And our next speaker, I'm hoping, will appear in the room. I know she's actually, she is as a delegate at the moment. She's just about to come on as a speaker. So straight on, we have our next speaker, which is Tina Wilson from Selina Finance. And I'll probably a slight difference to how I normally introduce somebody. Selina, when they launched in 2019, there's only been 3 occasions in all the years I've been involved in second charges that I've seen a product and I've gone, wow, that is a game changer. And Selina's was the first time was in 1997 with First Plus, 125% loan to values. The second time was 2013 with Optimum Credit, and their basically no rate card system scoring and the lowest rates I've ever seen, the rates as low as 2%. And the third one was the product from Selina in 2019, which really is a game changer. To see how much of a game changer it is, last week, slightly short staff because of the Jubilee week, so we had a few people out. So I dusted the cobwebs out of my brain and sort of got my hands dirty. And we had a particularly busy week. And there's a company today that were passing some second charge business over to us last week. So I actually, for the first time in ages, I was on the phone to customers doing fact finds. And every single one I spoke to, when I mentioned the different products we got available, and I mentioned the Selina product, they said, that's the one I want. That's what I'm after, because it is such a superb product. And last week alone, the fact finds I did was for £1.1 million. Now, that's a lot of business. And all of those at this moment in time are proceeding very, very nicely. We're expecting our first completion possibly on Monday from what I did last week. So a little bit on about Tina, first of all. And this is what you should receive from us. Now, even though we've sent this out, you see it's dated December 21, late yesterday afternoon, Selina notified us that they are changing their rates as of next, I believe it's Tuesday. So if there are any cases that you've got that you want to qualify on the existing rates, because the rates are increasing by about 0.5% in general, get them in quick, because if we get them on the system and we get the ESIS printed, then that rate will be fine, and for at least, I think it's about 7-8 weeks from memory. So get them in quickly. And we're expecting to be working the weekend to be getting cases on the system as quickly as we possibly can. Okay, some information about Tina. She's been working for Selina for the past 6 months as account manager for the south of England. She's enjoyed being part of a startup lender that has thrived over the past 18 months in the second charge market. Selina is the only lender to offer a regulated HELOC product in the market with no ERCs. I'll let Tina tell you what a HELOC is in a moment when she appears. Tina has worked in the mortgage industry for the past 10 years, from underwriting to becoming a BDM, working for market brokers and mortgage brokers and master brokers, my least favourite term, that one, by the way, in the specialist lending market. Okay, still not appeared. So someone from the team, you just let me know if there's any problems by poking your head around the door, just to let me know if there is an issue, because I'll have to talk very, very slowly, because that's a very interesting fact. There's not much of it. There she is. Christ for that. Okay, interesting fact. And this is why we don't argue with Tina. She used to represent Great Britain in judo. So how long ago was that, Tina?
Oh, too long ago, to be fair.
Yeah.
When I was from the age of 4 to the age of 19.
Wow. Okay. Did Olympics or anything like that? Did you ever get out? Did any of those or?
No. I had children just before I kind of got to that point.
Oh, okay. Right. No, I understand. Okay. Right. I'll let you crack on, because we are not quite behind time today, but this is one everyone that you want to watch, because this product is a game changer in what you can do for your clients. So Tina, over to you.
Thank you very much, Tony. So Tony's just given us an absolute amazing start, really. So as I said, Selina's been set up in the regulated market since 2012. 20, I think it was early on. It's been absolutely fantastic to join a startup company. I'd like to go through, first off, really about who we are. I'm going to go down first off. Sorry, I'm going to have to flick through because I've changed the way I want to talk to you today. So I'm going to start by this first off. So our rates at the moment are starting from 4.1 on our 65% LTV. We do lend up to £1 million. So our credit limit starts at 25,000 and goes up to £1 million. We lend up to 85% LTV as well. One of our biggest our biggest selling points really is that there's no early repayment charges across the board on any of our products. Our fee is £995, which I think is fairly low above the board at the moment. And I'm going to get myself started again. So our max term is 30 years. We do instant valuation, so the home track, and I think about 90% of the time, most of the cases do go through on the instant valuation, so no RICS valuations need to be done, which is fantastic. We also do first charge on unencumbered properties, and we do third charges where we sit behind another second charge lender. The only thing we won't sit behind at the moment is help to buy or shared ownership. So our HELOC product, which is one of our biggest selling points at the moment, which I absolutely love. I think it's absolutely fantastic, and we're the only lender in the market that offers this on a regulated term at the moment. So it offers a flexible drawdown facility for clients. It's just a bit like having an overdraft facility on their account, and they only pay interest on the fund that they draw down. So this can be secured against their main residence or their second home. If the second home, as long as it's not being rented out or other family members are living in there and renting it out, then that's absolutely fine. And it can be used for multiple purposes on this one as well. So the HELOC, the Home Equity Line of Credit, it's a very European product. We've managed to bring it over here, and to date, it's been amazing. And last month, we funded on £14.5 million, which is our biggest month to date. As it works, they have a facility where they can draw down or pay back whatever they want within the first 5 years. So within that time, if they're looking to purchase a buy-to-let property, do home improvements, they have them funds available, and they only have to draw down what they need at that point in time. On the drawdown, they will pay the capital and interest on the funds that they use. It works really, really well, as I said, with the home improvements. It also works really well with private school fees. I think it gives the clients the opportunity to have the funds there available for 5 years. They know that they can put their children through education. And with this, on the fifth and final year, once whatever they draw down, whatever the money's left over, will then go into the term loan. Pretty much it's one product, but two ways to use it. So you can either sell it as a HELOC, or you can sell it as a term loan, which will start from day one and go up to 30 years. On the HELOC, the minimum that they can draw down is £1,000. But they have the opportunity to, if they've got an electrician come in within 6 weeks and they don't want to draw the money down in one go, that they have the opportunity to have the funds available to them if they need to. This is just an example of how it works over the 5 years. So on the fifth and final year, as I said, whatever they've drawn down will remain, and it will then go into a term loan for the next 25 years. As you can see here. This works really well if they're looking to increase their buy-to-let portfolio and they wish to purchase other buy-to-let properties. They've got the funds there to be able to go and do that. And it works really well, again, with auction properties. So essentially, they're a cash buy when they go in with that. Weddings, hobbies, obviously that's a normal thing that we would lend on a second charge. With tax bills, we are happy to clear HMRC tax bills if we can see that they've been paying for the last 12 months. Debt consolidation is obviously another big thing for us. If they've got a few credit cards that they've not defaulted on, but they just wish to clear them all, again, we're happy to do that. And business purposes, if they're looking to expand their business or buy more equipment for their business, then the funds are there available for them. I really do think that the HELOC it's an unusual product to have, but I think it works really well. And a lot of brokers are scared to sell that as the HELOC because they don't really understand it. But honestly, I think if you look at it as an overdraft facility, it works really, really well. We've had a lot coming through for home improvements recently where I think the builders are not coming in. They've been given a timescale for about 6 months to a year. But in this case, at least they know they have the funds there available. So when the building work can start, or if it can start earlier, that they have the money available to do that. So I'm just going to go back quickly. Bear with me. So we have brought in some new policy updates at the moment. So we're now doing married sole applications, which we've never done before. And on our unencumbered first charge, we've changed it slightly. I am going to go through these with you. We've changed the way we look at self-employed, and we've also updated our valuation matrix just to make it a little bit easier to look at as well. But first off, just going over the unencumbered first charge. So if they have a property that obviously they've been inherited or they've managed to pay up the mortgage, then this is a really good product for them if they're looking to extend on the property or purchase a buy-to-let property to go with this. We will lend up to 500,000 on the first charge. We go up to 75% LTV as well. We do ask that the clients have a minimum of 5 active credit accounts. This can be communications, bank accounts, but they do need to have a minimum of 5 there. We was originally asking for ILA to be done, but we have now scrapped that. So I'm just going to go through that with you. So first off, our married sole applications. This is new on our policy. We had a lot of brokers that were asking for it. It seemed to be something that come up quite a lot when we were visiting brokers. So we had a conversation with our funding line and they agreed that, yeah, this would be absolutely amazing for us. So with the married sole applications, we will need a deed of consent from the spouse that's not going to be named on the application. The income will be from the person taking out, obviously, the application, but if there is any joint credit between them, we will take that into affordability as well. All the household expenditure is included in the affordability assessment. And I'm hoping that this is going to bring in a lot of business for you as well. Unencumbered first charges we just spoke about. So as I said, the ILA is now waived. We do not need this on the product anymore, which is fantastic. And I'm hoping to see more of these coming through. Self-employed, which is a big one for us. So during lockdown, if we were on furlough and we went straight back into work, no banks would even question it. As long as we're being paid salary again, then it's absolutely fine. And what we found with self-employed is that they were obviously having business and struggling throughout lockdown, but working probably harder than anyone else to try and keep their business up and running. So rather than punishing them, we're looking at the latest year income now, where before we were taking an average over the last 2 years as a 20% rule. We were averaging it out, but now we will take the latest year's figure, subject to an adequate projection and satisfactory accountant certificate along with that as well. If I can show you, I can't show you that, but I'll go back over that after for you. With the limited company, we're looking at this again a little bit differently. So where before we was taking the dividends drawn down from the retained profits, now we are looking at the net profit in place. So with this is on a referral basis if we are going to look at it this way. So what we will ask for is the cash position in the business, which will need to be put on the accountant certificate, and then we will take the whole lot into consideration. But I do want to go over that quickly with you. So as you can see here, on our old policy, we would take 36,500 with the average over the declared dividends. But now we're looking at the cash position within the company, and able to use that as well, which gives them, as you can see, a hell of a lot more money to be using towards the loan. On the latest year, on the self-employed, you can see here on our old policy, we would take 42,500, so just averaging out over the previous years. But now obviously we'll take the latest years, but it gives them a really good cash boost there. And with the director's salary as well up in that, which gives them a lot more money to play with. With our packaging and the way we look at documents and income, for self-employed, let's go back to the employed. For PAYE, all we ask for is 3 months pay slips. If they are working for a family member, we will require 3 months personal bank statements just to show that the money is going in as well. For self-employed, obviously the latest year's SA302 or an accountant certificate along with a projection just to show what they are bringing in. With the self-employed, again the same, the latest year's SA302 or an accountant certificate with the cash position obviously put at the bottom of that as well. But with these limited company, we will ask for 3 months business bank statements as well. As I said, the home track, that will go on there as well. We don't ask for passports or ID. We send it out a verified ID check for that to be done. If the home track comes back okay, then we won't ask for a RICS valuation. If a RICS valuation is needed, we will let the brokers know. And then we use Metropolis and Pure for that. So once that's all over, it's very, very quick and simple. It goes over into our portal. The portal is then locked and you should have an update within 48 hours from an underwriter with any requirements that are done. If the packaging is done perfectly, which we absolutely love, then we are able to produce a day one offer once it's been checked. And we had one a couple of weeks ago. We had the offer in the morning and it completed the next day. So we can get these done on a quick turnaround if need be, once our turnaround times change slightly. Is there any questions on the HELOC at the moment? Okay, so this is our valuation matrix for our home track. As you can see, I think we sit quite highly with the confidence level on this as well. We've simplified it slightly, so you can see when a RICS valuation is going to be needed and when a home track will fit in perfectly as well. With home improvements, if it is quite an extensive home improvement, and obviously with the home improvements, they will need to be able to live in the property. If they have to move out at any time, it isn't something, unfortunately, for us. But if there is extensive work that needs to be done, we will look at a RICS valuation to see how much the property will be worth. Just going back over everything else that we've gone through. So as I said, our minimum drawdown on this product is £1,000. They need that to just set up the HELOC. Once they've done that, then if they do need to draw down any more money, then it's just simply emailing into a particular email address that we have, asking for the funds, and the funds will be with them within 48 hours. It's really quick and simple. Just going over the income. So with the PAYE, obviously, as I said, we just require the pay slips. We will take into consideration bonus and overtime. We will look at that 50%. If they have buy-to-let properties in the background, we will look at them on an SA302 and we will take 90% of the income from that as well. The minimum age is 25 years and they have to be 75 at the end of the term. If it does go into retirement, we will look at the what they've been paying into their pension or assets that they have in the background that they are looking to maybe sell once retirement comes. The minimum income is £22,500 for a single applicant. If it is joint, then our minimum income is £30,000. We do look at adverse, so if they have missed one payment, not on a secured loan, it has to be on an unsecured loan, we will look at that if it's been in the last 12 months. And CCJs and defaults under £500 we will ignore as well. With defaults, with communication, we will ignore them completely. And if they have bankruptcy or IVA and has been discharged over the last 3 years, we will have a look at that as well. Debt management plans, if they are in that and they have been paying for the last 12 months, then we are happy to have a look at that to see if we can clear that for the client completely. And just going over the employment side of it all with contractors. So we love contractors as well at the moment, and I think the way we look at them is fantastic. So we will take their day rate and the days worked, we times it by the days they worked, and then we times that by 46 as well. They have to be we've been a contractor for 24 months or in the same kind of employment for 24 months previous to that as well. And just with the home improvements, just so you're aware that if it's anything under 49,000, all we will ask for is a detailed breakdown of what they're looking to do. For up from 50 to 99,000, then we'll ask for a builder's quotes, and anything above £100,000, we will ask for builder's quotes and planning permission as well. I think the flexible drawdown facility is absolutely amazing, and I really can't praise Selina enough for what they've done to get this up and running. As I said, we are the only lender that is offering this on a regulated basis at the moment, and we do have a lot of brokers now coming to us just for this option. I think that's it for everything I need to kind of go through on my presentation, Tony.
Just waiting for it to load up. There we go. Right. Thank you, Tina.
Sorry, Tina. This is the first one I've ever done, so you have to.
That is Tina's first ever presentation online. So a little round of applause. She's broken that cherry that we all have to face when we do these things.
I know.
It's never easy. It's very nerve-wracking for people. I've been doing this so long now, I can do it with my eyes shut. But sometimes it feels like I've got my eyes shut. It's not a complicated product. It's difficult for people to understand because it is so unique in the marketplace. To give him the ones that I did the fact finds on last week, one guy, £300,000 to finish the purchase of a property in Portugal that he needs the money on by next Friday of next week. That is ready to go once I get the accountant's letter back, which will be this afternoon. He's so happy that he's invited me to a black tie event at the Hilton Hotel Park Lane tonight for a boxing event, which unfortunately I can't go to. Another guy that we've literally had the accountant's reference in, another couple, the accountant's reference in this morning. That was the one I was expecting to complete over next week. It'll probably complete. Well, it'll be offered tomorrow, and potentially could complete a little bit quicker. So this is a product that's got so many different uses. If you've got clients that are buy-to-let investors and they want to keep increasing their portfolio, they could use this product purely for the deposits, buy a property, do it up, remortgage it, and then pay down the Selina loan until they get the next one. They can go on and on and on. And with rates at 4%, that's around 10 times cheaper than an overdraft. It's an absolute no-brainer for me. It really is an absolute no-brainer. Plus no ERCs.
Exactly. I think that's the biggest point.
It just really is. It's so if you're not using this product, as I said right at the start, you're not using this product. You might have clients that this would suit. Get them in before Monday to us so we can get them scored on the system. I'm not sure what time on Tuesday the system will actually click over to the new rates. So don't send them over at 6 o'clock. We've then got 50 to put on because it's not going to happen. But try and get them over to us as quickly as possible. And we'll then do what we need to do to get the ball rolling. Okay, right. We've got one question which from Femi, which he actually asked just as I was typing in the bit. So I thought it was originally asked for the previous speaker. But Femi's asked about council right to buy. This isn't a council. This isn't a purchase deal with Femi. They have to actually own the property. So it couldn't be used to actually buy a council house with borrowing more on top, for example, unless, of course, they had the cash to buy it, and then possibly it may be looked at in a different way. But no other questions. There's a few well done Tinas and very good Tinas. There you go. So you did all right. Don't you worry about a thing, Tina.
Thank you.
Questions you set yourself. There's a couple that you've sort of semi-answered, but just on one. What do we have to as the account holder or the agency holder have to provide for day rate contractors? What do you want to see?
We want to see a contract it has to be still 3 months left on the contract. If it's under that, then we'll ask for a new contract signed by both parties.
Okay. Do we have to provide ASTs if they have buy-to-lets in the background?
No, we will click on the system that they are self-funding, so we won't ask for any ASTs on buy-to-let properties.
Okay. Robert has asked, could a non-owner occupier landlord borrow against his buy-to-lets?
Not on the buy-to-let. It has to be on their secured property.
We do have, Selina do have another option which can be
Okay.
used on different types of property. We've got several options on that now because lenders have caught on to this great product, like an overdraft type product. I've been banging the drum with lenders and CEOs at lenders for years for something like this. And they're all going, oh, no, we don't think that will work. And guess what? Selina have launched theirs. They're all seeing how successful it's been. And most lenders are now trying to get a product designed, but they're so far behind because it does require huge changes to their IT systems. Because a drawdown facility is a lot more complicated than a single day one loan. So not expecting anyone to come out of anything soon, but they're pretty much all looking at it now. So it's a case of told you so, as far as I'm concerned, with a lot of them. So no more questions on that. One more question that you set yourself. Do we have to deduct tax and national insurance before adding to the portal?
No. So we will take that out in the background. So anything that's deductible, we will take out student loans, things like that. Obviously, you need to put that in. But tax and national insurance, we will take that out in the background. So please don't deduct that before you add that onto the portal. Okay.
That's all good. No more questions whatsoever. I don't think, and no one else is typing. So thank you very much, Tina. Come and see us soon. And because I think probably over the next couple of months, if last week's anything to go by, if you did 14 million last month, we could be accounting for coming up to about 10% of that in the coming months because it has gone mental. It really has.
Fantastic.
And they've probably got one of the easiest systems to use as well. I mean, I'm not particularly good with IT. If I can manage to actually navigate their system, anyone can. So everything's good. So, Tina, thank you very much. Don't leave the room yet. Simon will put you as a delegate again. And if you want to continue watching, you're more than welcome to do so. Go and pour yourself a stiff drink.
I think I need to. Thanks, Tony.
No problem at all. Nice to see you.
Bye.
Okay, now on to I know he's been in the room since right the start of this morning because I've seen him. So this is our final lender speaker. Old friend of mine, Andy Keehner from Catalyst Property Finance, who I've known for. I'm trying to think, but I think I've known him for as long as my youngest son has been alive, and he's 25 this year. So just goes to show there is, as you'll find out in a minute. I'll come on to the third slide. I won't say anything at the moment, but there is a very dodgy photograph of us floating around the market, which Andy did send to me a few years ago, and I couldn't find it. I was going to put it up, but I couldn't find it. So you should have received this this morning. So that's Catalyst's bridging finance, refurb development finance proposition. Now this is a lender set up by brokers. Now that makes a huge difference when it comes to basically products, service, everything else, because of course they know what we as brokers go through. So quite simply, they know exactly what they have to achieve and what is expected of them. So great lender to have on board. A little bit about Andy, first of all. Experienced business development manager and has worked in the specialist financial services industry for over 20 years as a broker, a distributor and a lender. And as he says there, he has an old photograph, a picture with me to prove it. And it really is. I mean, obviously, we're now both a little older and a little wider. But when I looked at that, I thought, blimey, how skinny was you? That's before kids. Before we got to the stage where kids were actually draining all my finances. So he's worked with Citi, UTB, United Trust Bank, Oblix, Positive Lending, and for the last 2 years, Catalyst. There are a few more before that. Swift Advances is the one that I remember where the photograph was. Was it Swift Advances you were at when the photo was taken?
I wasn't at. I was another broker, just like you.
You was a broker. That's all right. It was a Swift Advances do.
Indeed, at Lords.
Yes, that's the one. Yes, I remember it well. Yeah, much alcohol was partaken that day, from what I can remember.
I remember it well. Yeah.
Yet another, obviously, talented speaker. When Andy was younger, he was the British under-11 chess champion. So there you go. Another champion amongst our speakers. So, Andy, it's over to you. I will see you in about 20 minutes, hopefully, and good luck.
Thank you. Yes. Before anybody asks, no, I don't still play chess, but sometimes I'll have a laugh and pretend that I've never played it before if somebody gives me a challenge. But that's another thing. People usually do that with Paul. Yes, Catalyst. It's been great to come back to work for Chris Fairfax, who was originally one of the heads at Positive Lending. I worked there for nigh on 3 years for the packager, going out to see many, many brokers in my time there. And he always wanted to split off and set up a lender, which he's very successfully done. And I've come full circle working back for him. He does indeed know exactly what brokers need from a bridging product, more importantly. And he knows what the market is. And it's so the product offering that we have is second to none as far as I can see, and it's great to have in our armory. So if I proceed, yes, apologies for these faces. I just realized I'm the only one who's not actually bearing teeth, but this is our front line. These are the guys that should I not be available, these guys can pick up the phone and discuss any inquiries that you've got. And that's very important with bridging, because as I've always said, the bridging product itself is very simple. The trouble is the deal is always complicated. And this is why, if it's not something that you do day to day, the value of a packager is paramount. And it's really important to find somebody that knows the market, knows the lenders out there, because we all have our different niches, our different ways of working, and it's important to understand how each lender works. If we touch on what we do, so with bridging, we're looking at standard bridging here. So it'd be typically used for things like development exits, where it's all complete. It could just be a quick purchase, or maybe even a holding bridge where they're looking to do something with the property, but they're just not ready to do it yet. They may need to go in for planning, for example, but they haven't got that yet. So they just need a simple bridge to effectively bridge that gap as such. Typically, we're looking at loan to values up to 75% on a first charge. We do now have an 80% product. This is for small loans under 500,000, and is great for saving potentially a larger deal sometimes. And that's the same with the second charges, which we can now potentially get 75%. The gearing has gone up, even though there's a sense that properties are leveling off at the moment. We've used this many times to, as I say, structure a larger deal. It can be on their main residence, if it's for business purposes, which it normally is. We are an unregulated lender, so we do have to be a little bit careful there, as we can't do regulated loans, unfortunately. And also, we can look at different credit situations as we've got there. Yes, the criteria is going to be a little bit different, but there is the flexibility there. And we are talking about, you know, potentially old bankruptcies, old CCJs, even more recent stuff that's on their credit that they're just looking, obviously it's hindering them from getting mainstream lending. Loans of up to 24 months. We do have to make sure that the term we are giving is a minimum of 3 months, but there is only a minimum of 1 month's interest applicable to all of our bridging products. So if they were to redeem within month 2, they would just pay 2 months interest typically. Refurbishment loans is probably what we're mostly known for. And this is where we got most of our experience. And these are slightly more complex deals, as you can imagine. Light refurb, and medium refurb, we can potentially go usually go to 75% loan to value day one. We can now look at much heavier refurb products. And if you look at the definitions, this is quite important to understand where all the lines are drawn. And it's mainly calculated based on the cost of works compared to the current market value. So a light refurb project, for example, is where the cost of works is less than 50% of the current market value. It falls into medium if that's between 50 and 100% of the current market value, and then heavy if that is over 100%. So for example, you've got something where the property day one, the residual value of an office building is around 500,000. The cost to convert that office building is $1 million. Then this would then fall into heavy refurb. I see the percentage dropped off with the expansion point there. So that's the other thing that will push a deal into heavy refurb, is where they're extending the property by more than 25%. So we can consider some ground up elements to a building where they've got a house, they're looking to do double story side and rear extensions to this property, and it's going to significantly increase the footprint. The general rule is we can treat it as heavy refurb as long as there is one wall remaining. So they can knock the others down and effectively almost be a ground up project, but we can still treat this as heavy refurb. And where this benefits a lot of the time is bridging is generally less expensive than full-on development loans in terms of fees in general. We can consider inexperienced borrowers, inexperienced borrowers we can consider full stop, but to get the full loan to value, the full gearing, we will need them to employ an experienced contractor. However, for light and medium refurbs, if they're just looking, they may have experience with other firms, but this is actually their first of their own projects, for example, we can still consider that, but we may just have a 5% LTV reduction. Move on to Refurb Plus. Now, this is a fairly new product to really show how we are gearing up on so many properties. Now, the refurb products, which I just showed you, are based on retaining the interest. So that will then be deducted from the day one advance, depending on what the term is. So if it's a 12-month term that they're after, then you've got 12 months interest to deduct from that product. But here we've now introduced a rolled up product, and it's important to distinguish the difference because there are some lenders which will calculate the rolled interest but still deduct it. So this is rolled interest which is added to the loan, not deducted. So they'll get 75% day one, less of course the day one fees, maybe facility fee and so on, up to a maximum of 75% loan to GDV. So assuming that the increase in property value is enough to make sure that the loan to GDV is kept below 75% as well, we can roll the interest on top. Generally speaking, this will only be for light refurb, but we have now done the odd medium refurb by referral. It does include large conversion products, so we're not talking about small loans here. By definition, that light refurb, we're up to 50% at the cost of works compared to current market value. This could be a large commercial building that's worth $1 million day one, or even 2 million day one, and with £1 million worth of costs to convert that building is still considered light refurb, assuming that there is no additional ground up element that will increase it by that 25% or more. And again, inexperienced borrowers, particularly where they're employing an experienced contractor, will get the full loan to value product. Commercial, Typically, if it's a standard commercial that has no intention to be converted to residential, so it's just a quick bridge on a commercial property, we will typically be at 60% loan to value on these types of properties for a quick purchase. However, where we can push that a little bit is where there is an intention to convert this to residential, even if they haven't actually got the planning in. We can typically go to 65%, you know, sometimes even 70 on occasions, typically 65, based on the value that it is today on the commercial basis. They would then, sorry, just going back to that, once they've got the planning, we can convert it to one of our refurb products afterwards. Land with planning we will consider. We are restricted to southern counties at the minute. We'll need to be strong borrowers with full planning. We're typically looking for land deals where we can actually offer the development finance along with it. I'm not going to go too much into detail with development. It is a new product for us. It's a highly geared product. We can potentially go to 75% loan to GDV on this product. But again, at the minute, we're just restricting it to those southern counties that are mentioned here on the land with planning. So you're looking at Berkshire, Bristol, Buckinghamshire, Devon, and so on. Just to give you an indication of how our funding works, bridging lenders typically will have funding lines behind them. We have quite a good diverse set of funding lines behind us. So we're not trapped to one funding line that if they change their appetite, we're completely stalled. This was proven during the pandemic when Catalyst was one of the few lenders that carried on working. Yes, there was one of the funding lines, quite a good one, which did actually stop funding. But because we had the diverse funding lines behind us, we were able to carry on with another funding line and still offer very competitive products out there. We also have some high net worth individuals behind, which are great for those little top-ups and making sure that we do everything to try and save a deal. So if we get that slight down val on a deal, a lower than expected valuation on a deal, then we can hopefully try and work something and do our best to make sure we get that deal done. The second charge product of 75% often comes in here, you know, topping up on another buy-to-let property or even their main residence to save that deal. Just going through a couple of examples. This is a second charge example. Loan size 410. Our maximum is going to be 500,000 on the 75% product. It was on their main residence. They own several children's nurseries and just wanted to use this money to convert an ex-pub into another one. Much easier to do it as a quick second charge. We could have potentially looked at doing a full refurb loan on the pub itself, but admittedly, you then have to start getting involved with, you know, QS reports and so on. Second example is a moderate. This is more of a moderate refurb loan, allowing us to go to 70% day one on a commercial conversion. It was converting it to 7 luxury apartments with C3 use. I mentioned the C3 use because we can look at if they're going to convert it to holiday lets, and the end game is to put them onto an Airbnb type let, but it still has to have C3 use in the background, and there be no holiday let restrictions. So unfortunately, we can't lend on where it's going to become C1 usage. Last one is a finish and exit. This pretty much was this. So we don't necessarily need the development to be finished for us to step in. As long as it's nigh on air and wind type, wind and water type, I should say, we can take a look at it. And I just had a completion last month with exactly this. The windows and doors weren't actually in. The roof was on, the windows and doors were ready to go in, but they weren't actually in. They were just waiting on them to be delivered on site where they could go straight in. That development had stalled, so this was a great opportunity for us to continue it for them because their existing lender had fallen by the wayside. This one, they just needed to raise finance quickly because they had another site that they wanted to secure, and they needed to get the money out of this one to secure that site. So it's allowing them to steamroll on and get to the next site very nicely. With bridging, I think it's quite important. I'll now go on to the process. All bridging lenders will tell you the same. We give the best service, we're the quickest. There's only one way to really test that, and that's to use a particular lender. Again, this is the benefit of a packager who will likely have tested different lenders on your behalf effectively and know which one's going to give the best service and so on. To understand the service that's there, it's quite important to understand the process. The front end process is quite important, and that's where I obviously come in, because when an inquiry comes over to me, I need to be confident in our appetite and our products to make sure that the terms that I provide back to you and the way I'm structuring it is something that we can do. And there are things that, we need to make sure that we're thinking about, well, okay, this looks straightforward from the front end. However, there is a possibility, thinking about it, that this could be a situation or that could be a situation. Things like, for example, potential commercial buy-to-let situations and a deal becoming regulated, which obviously could cause a problem. So the process right at the beginning, I'm there for an email or a call. Try to get back to you as soon as I can from it. We'd like an outline of the deal, timescales involved, because it's quite common where it just needs to be done as quickly as possible. You get everything back to the broker or the client as quickly as possible, and then they disappear for weeks, and then they reappear several weeks later and go, right, I need this yesterday. And you're, well, where have you been all this time? And now you're expecting us to obviously do what we can, which we absolutely will. Understand their budget, what they've got to play with, their experience, obviously, for the refurb projects. Do we have to structure this as a new borrower? Is this their first project? We can still look at it, but we need to structure it accordingly. And competition, rate sensitive. This is really handy to know because we have our set structure on what most brokers and packages will want in terms of rate and proc fee, but there is sometimes another player, or they might be going somewhere else direct, and we need to actually home in what we're offering to make sure we can win that deal for you. If that means working together to maybe shave a bit off the rate, shave a bit off the proc, unfortunately we might have to do that as well, but as long as we're doing it together, we can make sure that we win these deals and we're not losing anything in the background. Once I will then get the indicative terms out. Once they're accepted, we'll get the full pack out. And this will include the heads of terms, plus all the forms that we need. I'll have assessed the application to determine what it is you need for this particular one and give you a shopping list accordingly. Typically, there'll be a schedule of works, A&L, ID, proof of address, the usual things that you would expect. We do unfortunately ask for a credit search to be carried out as well, to be sent in, ideally an Equifax or an Experian that we can attach to the file as well before it heads into underwriting. If you tell me at this stage that this is coming in quickly, I can also get the valuation quotes out there so we can get those back to see the timescales on valuations, because there are certain areas I have to admit are a bit of a problem, particularly east of England. seems to be a big problem for valuers at the minute. There aren't any out there at all. If you are a valuer in the east of England, you should be raking it in at the minute. Once that's in, I'll write it up and send it into the underwriting team, who will pretty much take over from there, and they will process the loan through to completion. They have SLAs to make sure that it is fully underwritten within 48 hours. If I haven't already got the valuation quotes, they will get them. They will get it instructed. Quite commonly, though, I've already done that. And we'll get these solicitors instructed. We should be doing that within 24 hours, as long as we've been given, obviously, the client solicitor's details. Sometimes they're omitting. Obviously, we can't instruct the solicitors if that's the case. And we will get our solicitors instructed. At the moment, we're typically using Field Fisher and Howard Kennedy, who are giving us a very good service, I have to say. And they will send the initial inquiries to the client solicitor. It's important at this stage to know where the big delay is with any deal, and that is with the undertaking. Our solicitors will not do any more until the undertaking has been confirmed as being paid by the client solicitor. Now, quite commonly, deliberately, the client is waiting on the valuation report to come back and all of that to be signed off before they will pay the undertaking for the solicitors to proceed, which is understandable. But if they're looking for something to be done very, very quickly, they will need to do this straight away, and they will need to pay it straight away so we can get going and the inquiry sent back so that our solicitors can get ahead on the deal. We can typically use title insurance for most cases. There will, unless solicitors are advising us not to. For certain deals, this will be the case. Building insurance is always the last thing to arrive on the day of completion, along with the report and title, and then we'll request the funds. The deal completes, and we pay the broker invoice. We aim to pay the broker invoice the same day. There's no holding on to your commission, waiting for an interest payment. That should be paid the same day. And that's it. Any questions?
I'm back. None asked by the delegates, so I'll go straight into the stuff you set yourself, Andy. So what makes Catalyst different?
Yeah, well, this is very open-ended.
The 3 million other bridging lenders there are in the marketplace.
Absolutely. I would say customer focus more than anything. It's not just about the day one rates that you should be looking at. And this is such a common mistake that I see from brokers. And it's nice sometimes to see questions like, what's your default rate? What happens if it goes over term? And this sort of thing, because these are very relevant questions for such a short-term lending. And, you know, we're having to bail out, you know, rebridge. Rebridging is not a problem for us, where we've had to get them out from a lender that may have had a good day one rate. It's coming to the end and they're being asked to pay extortionate fees for going over their term or extension fees. We typically, you know, the last thing we want to do is put somebody into default. We do have a very, very low default rate anyway, but it's very rare somebody goes into it. Our default rate is 0.75% a month above the day one rate. And now most other lenders that I see are 2, 3. I've even seen 5% out there with some lenders, and they also charge 5% just for going over term. You know, there's some real extortionate ones out there that you really have to be careful of. These step rates that are out there, you have to be so careful of. They offer these step rates because they know that these loans will be held, generally speaking, more than 6 months. So that's when you start kicking into the even higher rates. You know, we don't like that kind of policy, really. You know, we only charge 0.5% to extend by 3 months at the end of the term. And we certainly do work with the client to make sure that we're doing everything we can not to foreclose. And I think that is shown in our default rates, to be honest. Just a little word of advice for all delegates. If you are using bridging yourself, if you are going direct to bridging lenders, not using a packager, steer clear of many, I won't say names here because I can't, because I'll get sued,
but steer clear of many of the peer-to-peer lenders, because they are the ones that they don't do proper due diligence, first of all, on the title on the property. And therefore, when a lender comes to refinance, there's loads and loads of problems with it, because they make their money when the deal goes over term. Because they're paying such high returns to their investors, when a deal goes over term, the payments stop to their investors or reduce to the investors, and they absolutely annihilate the clients. I've got 2 clients who during COVID were being charged, up to when 2 of them were charged over £100,000 because they weren't able to refinance during COVID. Now, all that's going to do for the industry is the FCA will find out, and that will bring unwanted attention. And what happens? It gets regulated. The whole lot gets regulated, which is the absolute last thing we want, because let's face it, has regulation done any good for the mortgage market? No, not really. Not over the past 18 odd years. It's brought a little bit. Has it cut out the cowboys? Absolutely not. Really doesn't. But just be careful who you use, because there are some lenders out there who really should not be lending. And they will be the ones that have already exited the market and are lying on a beach somewhere when the FCA do walk in. So just be careful who you use. Peer-to-peer, we do not touch with a barge pole. So what won't Catalyst lend on, Andy? I'll get off my soapbox.
So quite common one that we get is commercial, hospitality, trading pubs, restaurants, golf clubs, that sort of thing. Unfortunately, that is not our bag. If there is no intention to convert any of it to residential, only there has to be that intention, basically. That's probably the biggest one.
Okay. And final question: what is your most popular product? What do you lend on the most?
The Refurb Plus right now. It's maximum gearing. Nearly every single inquiry I've got doesn't say how much they need. It just says maximum LTV, please, maximum gearing, and less worried about the rate itself. It's just maximum gearing. So 75, a light refurb product. It can be done for conversions. I didn't mention the fact that it could be used for HMO conversions. Is quite a common one that we see, and they just want day one 75%, less of the fees, interest rolled up. And that's without a doubt mostly what I'm issuing.
Okay, and with all the changes that happened to EPCs, as I mentioned earlier on when I first spoke, tying up with a great bridge lender for a great packager, and we got packager status through Catalyst. And I know with my team, Catalyst is certainly one of their favourite lenders. It could reap dividends for you, because we do know their stuff inside out. We've no questions from delegates, Andy, which is always either they've all gone to sleep, which I doubt, or you covered everything that needed to be covered. So thanks very much, mate. Good to see you. And come in the office soon. Nice to see people face to face again. So Simon will remove you as a speaker, and we will now go on to the final bit, which is little old me. So, not big old me. But I'm going to cover 2 things that have happened that I see as quite major. And there's one particular, the very first one is this one. Now, this at New Lenderston Marketplace, I attended, I don't often do this, is the first one I've done since lockdown, but I attended one of the physical roadshows in Watford. I think it was the Financial Reporter Roadshow in Watford, a hotel that very soon is going to be knocked down. And you could tell it's going to be knocked down because none of the toilets had locks on them. Some of them didn't actually have doors on them. The bacon rolls they started up were all stale. The lunch when they were serving it looked absolutely appalling, so I left early. But one of the good things that came from this was the fact that Quantum Mortgages were presenting. So when I walked in, I saw their sales and marketing director, Spencer, who I've known since the late 90s. He was our BDM for a company you might remember called iGroup, that was a very big player in the specialist market. And he was our BDM for quite some time. So I saw him. He said, "You're on my list to contact." I said, "Well, I'm here now." So we've just been granted packager status with Quantum. And this is a lender that I think is going to make some major changes, because they're lending on property types that really are underserved in the market. I'll go through each of these now. We know there's lenders out there who do deck access flats, for example. There's very, very few other restrictions when it comes to deck access flats with Quantum. Obviously, mostly they're normally ex-council anyway, but there's very few restrictions on the number of floors, for example, anything like that. No minimum income whatsoever. They don't even ask the question. This is a good one. Gifted deposits from any family member. In their words, if it's second cousin 15 times removed, as long as they can just make sure that the funds haven't come from an illicit in an illicit way, they will accept it. So we see this as a big, because some lenders, they do get very funny over this. It has to be an immediate family member. We've managed to get one through a lender recently where they were divorced and his ex-wife has given him back the money. Must have been an amicable divorce. But that can be a big, but of course we still need to check that it's come from a reputable source, the funds. Day one remortgage accepted, it can literally be the day after. As to, the question was asked earlier about the DS1, whether that would be required. I'll have to refer back to them and see exactly. I don't believe, as long as it's the same solicitor, they're more than happy. They have open banking, electronic ID, which cuts out a lot of the nonsense we have to get for customers these days. No first-time land. This is the only time I'm going to say no in a negative way when it comes to Quantum. No first-time landlords. Minimum of one property should have been owned for 1 year. But sensibly, unlike many lenders who say, no, they must have owned it for a year when you apply, with Quantum, they must have owned it for a year when their mortgage completes. So if they've owned it for 8 months and then it's a purchase and another purchase, and we know it's going to take a while to complete, they would just basically put something in the offer. It cannot complete until a certain date. But it just means that it's something that we can do. That is the only negative at the moment, but they've turned it into pretty much a positive. They will lend on flats above and adjacent to commercial. They don't care what it is, as long as it's not a petrol station, as long as it's not a factory that's got dangerous chemicals. They will lend above fish and chip shops. They'll lend above kebab houses. They'll lend above anything of that nature at all. We recently had a case with a specialist lender whose criteria says subject to valuer's comments. Now, that to me is absolutely ridiculous. You could have one valuer go out and say, yeah, we're happy with that flat above a fish and chip shop. And a valuer within the same firm can go out who doesn't like fish and chips and say, no, you shouldn't lend on that. It would affect marketability. That's daft. It should be either yes, we do, or no, we don't. Quantum will lend on literally anything. Dry cleaners, no issue. Anything of that nature. Above pubs, above nightclubs, they don't care. And the last one, this was mentioned earlier on, they will lend on studio flats under 30 square metres, whether they are single studio flats, and the lowest they've lent on so far, which I'm told was a property in Knightsbridge, which sounds like a broom cupboard, was 11 square metres. So again, that's an area of the market that really has been underserved for far too long. Yes, okay. If it's a 15 square metres up in Bolton, for example, is that going to be difficult to sell on? It's probably not going to be worth anything anyway. But in certain areas, under 30 square metres is the norm, especially in certain parts of London. And this was a very interesting, when we had a presentation from Spencer, their sales and marketing director, on Tuesday to the staff. And this, I pinched this slide from their presentation. So quite simply, this is where they say no. So there's no credit scoring. If they're looking to remortgage like for like an existing product, there's no ICR calculation, which I think is great. So there's some lenders out there who've been charging fairly high rates with 100% rental coverage, for example. And ERCs may have expired because normally they're only for 2 or 3 years. So you can put them onto a much cheaper rate with Quantum, with no ICR calculation, no business plans, which I think is very sensible, because I get to come across a lender who can actually read and understand a business plan. Assets and liability statements, minimum time and ownership, no PGs below 50%, no pay slips, etc. I'm not going to read the whole lot because otherwise I'll be here all day. But a great lender to have on board. Say we've got packager status, and one of the things that will come to in a minute is whether you want one of our documents that the Quantum are now included in there, and details of what we receive and what we give away. But a great lender. Anything you've got on your desk that might fit into any of those particular scenarios, you know where we are. This is the second bit of news, which is also game-changing as well. We've already had Selina presenting. Now, Scroll Finance, which has been set up by two guys with extensive experience within the second charge market. And their managing director was formerly the managing director of Paragon for 23 years, a guy called John Webb, who I've known for probably 35 odd years. He's brought up to set this up. Now, this is an absolutely superb product. So this is lending on buy-to-lets, shortly on HMOs and multi-unit freehold blocks, 25 to 1 million. And this is quite simply exactly the same as Selina. It is a HELOC, so home equity line of credit, although they don't call it that, they call it something else. But it's very similar, overdraft facility. Customer can draw what he needs. Already, we're seeing a lot of interest from some of our introducers or broker partners on this product. LTV is up to 80%, rates from 4.75%. No ERCs again. Fabulous product, absolutely fabulous product. So if you've got where you've got your clients, you've been writing 5 and 7 year fixed rates over the past few years, and they've still got the ERCs. The other thing they will do is if you have a client that you wrote a 5-year fixed rate 2 years ago, Scroll will advance and will actually match the fixed rate that's remaining. So when you then come to refinance that client, which no doubt you will do, the fixed rate, so it's a great selling point to a client. So yeah, the fixed rate will match your existing fixed rate with no ERCs. Fabulous product, absolutely fabulous. We will be selling this like you wouldn't believe. We really will. If you're involved in the buy-to-let market, add it to your chest of products as quickly as possible. There's only about half a dozen companies that have got this product, and we're lucky to be one of them. So a little bit of information about us, what we can do for you. I always cover this because I know probably half of the delegates today have never used us before. I know we've got a couple of representatives within the networks that's fairly seen within network. So welcome. Hopefully you like what you've seen so far. But this is a little bit about what we do. We do it slightly differently because we have been around a long time. So we see what we do with all of you as a partnership. Quite simply, it's about two entities trusting each other, a partnership. It's ensuring that if you're placing business with us to place with a lender, for example, either a package or with us giving advice, that we're getting the right information. And of course, you've got to trust that we're going to do what we say we do, that we're going to pay you on time, etc., etc. It's also just ensuring, it's also when we get silly situations, one of my staff being berated by a broker yesterday because the valuer wasn't able to get out and see the property for another week, and it was going to take probably up to 10 days to get the valuation. Not much we can do about that. So sometimes understanding what the market restraints are. Lenders are all very, very busy at the moment because base rates have gone up. We've seen a massive increase in inquiries, which is great. That's exactly what we want. We want to see inquiries coming through. We're all working incredibly hard. We can't do much about lenders' turnaround times. Unless there's a situation where I can maybe contact somebody that I know is higher up the food chain and say, can you maybe slip this one higher up the pile, which we can do on occasions, but we can't do it on every occasion. So it's just understanding what sometimes the restrictions are in the marketplace, and everybody is busy. I mean, some lenders have got a 15-day turnaround at the moment. We want to help you grow your business. Already seen right at the start, we want to make sure you're compliant, for example. So we've issued the GDPR documents. Other ways we can help you grow your business as well. Talk to us and we can actually show you what they are. Doesn't matter what your status is, directly authorized. If you're an AR within a network and your network is, we're not on the panel of your network, get the hierarchy within your network to give us a call. Because when people use us, they very rarely want to use anybody else. Exempt professional, not authorized. We have to be careful if you're not authorized, because if you try and give us regulated business, it's not covered by our PI cover. But there are ways we can actually still take business from you and keep you compliant and keep you within regulation. And we want to make sure you stay informed and compliant. The industry is terrible, I mean, especially the regulator. It's terrible at telling us what's going on. Let's face it, because you get something from the FCA, you normally lose interest after about 20 seconds of what you're reading, because it's been written by somebody who's probably just left university and thinks we all speak the way they speak. We don't. Generally, we have to speak in plain English to our clients, and that's normally the way we do speak. So we want to make sure you stay around writing business indefinitely. 2009, not only do I not have any lenders, but I saw introducers going by the wayside like you wouldn't believe. The second charge market went down to about 13, 14 brokers. What was called master brokers, which is a term I absolutely hate, but literally that bad, from close on 1,000, which we were one. So we want to make sure that you're around and we're able to partner with you in getting business through for your customers. Our products, literally everything except for equity release, which I'm not keen on as a product. So I let others use that. There's plenty out there selling it like crazy. But it's not something that I want to get involved in. But literally everything else. And the thing is, we've got masses of experience in every single aspect of these. I mentioned how long I've been doing it. I've got one member of staff in my regulated team who's been with me since 1997. My most experienced member of staff has actually been in the industry since 1995. So we do know what we're doing. I don't take on people that have only been in the industry for 15 minutes. I just don't do it. Our service, packaged or unpackaged, packaged or introduced only, you choose. And it's not a case that all your cases have to be packaged or all your cases have to be non-packaged. You can pick and choose depending on the product, depending on the time of year. If you're about to go on holiday, normally we just package your business, but you're not going to be around for 3 weeks, then we will help you out and do the fact finds and do all the basic processing and everything else. That's what we're here for. And we've got the experience to do that. Not many packagers have that experience. And we all know that it depends on basically sometimes your workload might be as such that you think, I can't deal with cases, with any more cases at the moment. I need to offload some to somebody who knows what they're doing. That's what we're here for. And why are we different? Not the products we offer. We offer exactly the same as everybody else out there, pretty much. We've got a few semi-exclusives. I've got 1 or 2 sole exclusive products nobody else has got, which are great. But in the main, we're offering exactly what everybody else offers. I've mentioned the people we employ. Minimum 5 years specialist financial services experience, not somebody who's been in Nationwide for 10 years working behind the counter. They need to have worked, I prefer as a broker, but if they work within a lender within the specialist market, also acceptable. But that is an absolute minimum to get through the door just for an interview. Multilingual. I'm not going to try and pronounce any of those because I always pronounce them incorrectly. And if any of you speak any of those languages, you probably laugh if I did try to pronounce them. But I need to update this. We've got another member of staff who actually speaks some Hebrew, which has come in very handy recently. But the main thing is mature with life experience. All of my staff, every single one of my staff is aged in mid-30s and up, and they've got that life experience. It means when you speak to them, you're speaking to somebody you would speak to as an equal. You're not speaking to somebody that you think, my God, you haven't got a clue what you're talking about. And I find that is absolutely vital. And there's some feedback we was given back this was July 2020. I'm going to probably need to update this now because this particular broker partner who gives us a lot of business, he's semi-retired. Quite simply, every member of your staff I speak to is incredibly knowledgeable, polite, and looks to find the best deal for my client. You can tell they've been working in the industry for a long time. They really know their stuff. Every client I passed over to your company has raved about them. He did say to me, I wish I found you years ago when I was still working properly within financial services. We would have shed loads of business together. We're doing a fair amount at the moment. He's got a £7 million case completed, hopefully on Monday. So he's not doing too bad. Loving why we're different, our lender relationships, because I've been doing this so long. Scroll Finance, for example, John Webb I've known since the 80s, who's their MD. And that's the same for many of the lenders we deal with, because I've grown up with people who started off as BDMs. Guy from Quantum, as an example, who's now in a director role. We've got that type of relationship. It's a relationship that's been going on for many, many years. And that can help tremendously. And I'll come on to that in a moment. How seriously we take compliance. We were told by the NACFB we were a country mile ahead of any other broker they'd seen with our compliance, which is great to hear. We've got our next compliance coming up literally. I'm still trying to get it organised, but probably within the next couple of weeks. Hopefully it'll be a good one. I know it'll be a good one, and it will be on next month, hopefully. How seriously we take prevention of financial crime. We don't come across a lot of it. In lockdown, all of a sudden, it seemed to be quite popular. We did come across quite a bit, and none of it went through. Reported single one of them on action fraud, and every single one of them, the police came back and said, we're not taking any further action. So although we have to do something about it, unfortunately, the police and the courts really don't seem to want to. And it's not unnumerous awards from the financial press. Now, I'm very much, and those of you who watched this before know that I'm not a fan of broker awards. There's a reason I'm not a fan of broker awards, because it's just basically corrupt. Quite simply, exactly that. Best Newcomer Award at an awards due, how long ago was it? About 5 years ago. Best Newcomer was for a company that hadn't even launched yet. They were launching the following day, but had already spent 20 grand in advertising with that particular publication. It's corrupt, believe me. And an example of how corrupt it is, if you can win an award because you've got your 500 Facebook mates voting for you who've never taken out finance for your company, then what's the point? Especially when you're able to offer them a £250. One lucky winner will win a £250 Amazon voucher. I mean, it's just absolutely daft. So when you see brokers that have won awards, and I'm not saying all of them have done anything dodgy. That's not the case at all. But just take it with a pinch of salt. And if you've ever been to an awards do and you've seen the reaction, it's always the same people, and seen the reaction of someone. I've seen a grown man lock himself in the toilet because he didn't win an award. It was quite pathetic. I think he was crying. Absolutely pathetic. So just take it with a pinch of salt. You will not see me get, if you do see me at an awards do, and I get an award for anything other than lifetime achievement, because I've been doing this donkey's years now, come up to me and punch me in the face, because I shouldn't be getting one, because I will not enter myself in for something. Okay, what else can we offer? Designated underwriters from start to finish. We don't have a sales team, an underwriting team, a completions team, etc., etc. None of that at all. One person from start to finish. Unless, like last week, I have to get involved because of business volumes. But even then, I think I should know how to do a fact line by now. I've been doing it long enough. Commission is paid on the day of completion, as long as we have your bank details. No excuses whatsoever. As some of you will know, I have in the past paid commission on the day I renewed my wedding vows. Back in 2018, when I was in Spain with all my family, I paid commission when my daughter got married in 2019, in between her saying I do and me giving my speech. And last year, I was having an operation for a dodgy shoulder, and I paid a broker commission the night of my operation. When I'd come to and was actually able to actually work my phone, I paid a broker then. So as long as you got your bank details, we will pay your commission. Doesn't matter if we don't get paid for a month, you get paid on the day of completion. Every time, no excuses, and no commission clawbacks, unless it's fraud or unless the customer obviously cancels the contract within 14 days, which most lenders will allow. What else we can offer? Very important. Andy from Catalyst mentioned that he needs a credit search. We're very lucky because we're a second charge broker. We have access to a large number of Equifax and Experian accounts, which means, because second charge lenders are basically lazy and they don't want to do the searches themselves, so they only see the case pretty much when it's submitted, and quite often that will be with the search. So we have direct access to Equifax and Experian. We will do a search as soon as we've got the customer's authority to do so, just to ensure that right from the outset we're not heading down the wrong road, down that cul-de-sac where you have to then turn around, go back to the beginning, to square one, because the client didn't tell you they had 5 CCJs for £5,000 each. They didn't think anyone would find out. So, and we all know that happens. It means that we, right from day one, as soon as we do that search, we know what to expect, which lenders love, absolutely love, because it means we're not giving them business and they're working on business that then just collapses because the client lied. What else we can offer is that all of our business is sourced through our own in-house software. The reason we did this was because although there's software out there for first mortgages and it's sufficient at best, I really didn't think there was anything out there on the second charge side that was any good whatsoever. So we've actually written our own. The commercial side, this includes all our specialist lenders, which don't appear on TriGold, Mortgage Brain, and 27 Tech. So quite simply, this will not only be able to give you a quote of what it calculates the rental cover calculations. So we know that client actually fits for that particular product. We know when there's tolerance levels with certain lenders that we just need to refer the case. So rather than be declined, which it would be if you went on to some of the sourcing systems that I've just mentioned, lenders wouldn't even appear. Well, on our system, it will appear because we know that lenders do have a tolerance. On the bridging side, that was the most difficult one because bridging lenders all work differently. And it's only when you actually delve deeper into the way they work, you find out just some of the hidden charges you got with certain lenders who aren't on our panel anymore. So we just can ensure, so within 45 seconds of you giving us a lead on the phone, we can have pretty much sitting on your desktop a PDF with the quote. And up to 4 quotes as well of what's available. Can save the amount of time that saves, but just across the board in all our quoting systems is immense. Data security, since that episode in 2015, I have made sure that nobody is going to be getting into our systems at all. We're very, very hot on that. And we offer full training, face-to-face or virtual, totally free of charge. If you're based up in Newcastle, I'm not going to be doing any face-to-face training because I don't want to spend an overnighter just to train someone. We can do that. But anything a little bit closer, probably within 100 miles, more than happy to come do some training. Our second charge panel, literally everybody, everyone that is out there lending at this moment in time, we deal with. And that will probably always be the case because I'm now the second longest serving person in the second charge industry, I'm told, continuous serving in the second charge industry. So we do deal with everybody. On our regulated first charge panel, this is quite important actually, because normally after every one of these we do get some first charges over, which is where it's probably been sitting on your desk for probably 2-3 weeks, sometimes months. And I've had one broker who gave me 8 cases that had been sitting on his desk for months after we did one of these, and it was some real crud business, but we did manage to get some of it through. But these are the ones where you can give the advice and we can package. So we are a packager for Together, Precise, Foundation, Central, all the ones you can see there. Family Building Society, got some great products with them, especially on the 5-year fixed rates. They're all semi-exclusive, so not stuff that you can access yourself. So give us a call on those. Our specialist buy-to-let panel, we've got loads more, obviously, but this is one where we deal with introducers. There's no point in putting the likes of TMW and Birmingham Midshires and others on there, because you probably deal with them yourselves. There'll be someone there that you can't deal with, and probably someone that you've never heard of. But that pretty much covers everybody in the marketplace. And if you want to give the advice, these are the ones that we package for. So pretty much all the ones there. We've just added Quantum in, literally, I put them on there last night. Foundation, another one we've recently added. All of those we can package on your behalf. And don't forget, we pay your prop fee on the day of completion. And there's no other packager out there that I'm aware of that can say the same. If you use one of these, we're not on for all of them yet. I'm still trying to get some of these to actually get these organised. But I know they're very busy with all what's been going on. But if you use one of the normal sourcing systems and you do come across a deal that goes with one of those lenders, give us a call. The reason give us a call is because we do not charge any packaging fees. So as you can see there, that's a comparison. That's just when I did this, that was just the ones we had on that stage. As you can see, anything as high compared to charge anything up to 300 quid. We don't charge a bean, not a bean. So give us a go. If you're using any of those lenders through a packager, give us a go. My staff have been doing it probably far longer than anyone else you'll be dealing with other packages. Bridging panel, advised or non-advised, I've got loads more than that, but that's pretty much the ones that where we do have packager status, so therefore we get more than if you went direct. And our commercial panel, same again, we deal with pretty much across the board, so every scenario you can think of, from the cleanest to the clean, up to the dirtiest to the dirty. We've got a few private lenders as well that I don't publicise too much. We use as and when we need to for the weird and wonderful stuff. But again, there's stuff on there that you would not be able to access direct yourself. And because of the amounts of business we do tend to get some stuff that you would not be able to see yourself. If it comes to second charges, if you want to advise on a second charge, we can help you do that. I realise there's been some massive barriers to mortgage brokers offering second charges from some of my competitors, in that you've got clients being charged up to £5,000 or more in some cases. Well, again, we do not charge any packager fees on our second charges if you wish to give the advice. So quite simply, all of those bits there, we help you. We instruct the surveys. We instruct things like second charge requests. Obviously, we need payment for those before we can instruct them. We package a case, check all documentation to make sure it sells through. We've got a large number of brokers using this service now. And we do give away some of the prop fee on certain deals, certainly not on 10 grand deals. We don't, because otherwise we wouldn't earn anything. But on some of the larger deals, we do give away some of the prop fee to you as well. And you can charge whatever you want. If you want to charge £5,000, you can charge £5,000 on the second charge. And I've got one broker who does it on every single case. If you want to charge 395 quid, because that is basically that's what you would normally charge on a mortgage, you can do that too. Entirely up to you how you want to work it. If you would like to know exactly what we pay on that, just type in the word PROC in the type your message box below, and that will be emailed over today. That has literally been updated last night with some new lenders and some other bits and pieces. So just type that in, and that will come out to you today. And it covers a large number of lenders. It's now up to about, I think it's 10.5 pages of different lenders, and hopefully it's very easy to read and very easy to navigate. But that gives you an idea of exactly what we pay away. I would also just warn you, be aware of the bandits that are out there, because there's still quite a few out there. So if you're using other master brokers, as they like to call themselves, just be careful as to how much you're being paid. This was a genuine case, a 2018 roadshow we did, 1.4 million case that had to go to Interbay because of client circumstances. And the delegate had been promised 0.5% because Interbay did not pay a prop fee to the master broker. Absolute lies, because they pay 1.5% minimum. The master broker's income They were trying to charge a 30 grand fee, but they reduced it to 24,500 as their final offer, which the client was prepared to accept. They were earning 45.5 grand and paying away 7. We took that deal to put it to Interbay, shared the prop fee with the introducer, didn't charge any fees whatsoever. Very happy client, delighted introducer because he earned more money than if he'd gone through this other cowboy outfit. And of course, we were happy because we got the deal ourselves. So just beware who you're using and just check sometimes if you are using somebody else, what you're being paid and how much they're earning. A couple of case studies. This was one not that long ago. It was, I think within the last 6 odd weeks. Incredibly complicated deal in that there were structures involved in Panama and all over the place, but managed to restructure certain parts of it to make it acceptable. Got this through Yorkshire Building Society Commercial Mortgages, who are a very, very strict lender. As you can imagine, as a building society, they only take on top quality business. As you can read there, basically, there was a third director had to be repaid from the advance. Introduced rent £12,187.50p on the day of completion. Second one, this is one that we did last June. This is one that I was heavily involved in because I still had staff that were on furlough and working from home. So I thought I'd get involved because there was some complications on it. Loads of properties in Holloway, very close to actually where my son was living. And he needed to raise money to purchase a flat so he could then also own the freehold. He owned 2 flats within the block. He wanted to purchase the third, and he was on a bit of a deadline. Absolutely, as typical with London properties, the rental yield was not great. But with Octane Capital, we have a product where they only require 100% rental coverage. And this came out 101%. Introduced rent 32.5 grand from the advance, 20 grand on the day of completion, 12.5 the following day because my bank restricts 20 grand on single payments of this nature other than staff salaries. So we paid it over 2, but he was more than happy. Great. This guy's now designing the kitchen. The client is actually a kitchen designer and installer. He's designing the kitchen for me free of charge. Third case study, 75-year-old expat with Hampshire Trust Bank. We're one of their largest brokers and have been for some time. Expat in South America for more than 10 years, had no other property in the UK, wanted funds for his retirement, which is quite an unusual one, and also replace some existing credit card debt. We packaged that case, introduced a partner, just under 4,400 day completion. Fourth one, this was towards the end of last year, and we're currently arranging the exit for this one. 20-bed HMO property, or 20-bed property that had planning for a 10-bed HMO, was probably being used as for more than 10 beds illegally. One major issue was that the neighbour had actually gone into that property's electrics, so been nicking the electric supply for years. It was discovered between valuation and completion. So that was sorted out. 2.15 million, 21,000 pounds, again paid to the introducer on completion, 20 grand one day, a grand and 1,050 the following day. So again, type of deal we can get through, and that was because of contacts we got within that particular lender that we was able to get that deal through. And this is probably the best one I've got. I'm still trying to get through. If you were with us last month, I did mention we got a deal going through for somebody convicted of manslaughter. That one is still going through, so I can't sort of like put that on here yet. If I do get it through, it will probably replace this one. It's one of the most difficult ones I've ever done. But this one was a husband and wife business, running children's nurseries. Husband was also a pilot. And the husband, running the financial side, defrauded HMRC of 850 grand over years and years and years. Basically hadn't paid them any money at all for any of their staff. So as you can imagine, when it was found out, Mr. was sent to prison. Mrs. knew nothing about it. That wasn't her side of the business, and that was proved. Mr. was sent to prison. They divorced. Proceeds of Crime Act charge against every property that he had an interest in, including their home, including both children's nurseries. Barclays called in the mortgages on both children's nurseries. Northern Rock went overturned when they were calling their mortgage. A couple of buy-to-lets were being called in, and it had been declined by multiple lenders across the industry because of reputational risk. It came to us. My underwriters did the same, started doing the due diligence, put it across to a few lenders. No, can't touch this. Compliance departments love this sort of deal because they can say no. So we contacted Together Money, and I believe that a couple of other brokers had also contacted Together. Their underwriter referred it, declined by the compliance department. So case came to me to sign off. So what did I do? I immediately phoned one of the directors at Together because it was less than 50% LTV. Client had 300, she had 300 grand sitting in the business account, but it was nowhere near enough to repay the proceeds of Crime Act charge. So 10-minute conversation with the director at Together. He said, well, I'd like to do that. Let me go and speak to my compliance department. Now, there's a big difference when an underwriter goes to a compliance department where they go, haha, we're more powerful than you, and they say no. It's when a director goes to a compliance department and they go, oops, we're scared. We might have to say yes. And they did say yes. And we managed to get this through, paid off all the proceeds of Crime Act charge. And the client, within probably 18 months, I think it was, had then gone back onto the high street with the commercial mortgages with Lloyds, not Barclays, but Lloyds, and also had refinanced their Northern Rock mortgage. Sorry, their Together mortgage that we used to repay Northern Rock. So she's now back to where she should have been. And that was all because of one phone call. The other option would have, she would have lost the lot, absolutely everything, because of what her husband did. Introduce her just under 12 grand on the day of completion. And this is what he said. I won't read the whole thing, just a bit that's underlined. The service you and your team provided and continued to provide is second to none and well beaten. And he's been using this ever since for everything that that comes through to him, because we got a deal through that he tried through a number of other packages, or as they like to call themselves, master brokers. So cases you can't place. If you've got anything you can't place, you could either, there's obviously many ways of submitting business to us, just type your message, type in the message box below and we'll come back to you. Send us over a decision in principle form, which will be sent out to you this afternoon. There's one for every product. Go to our website and you can send online, or just give us a call and run through the case, and we can give you an idea straight away whether it's doable or not. Then decide if you want a package, no problem. If we're going to do the legwork, then we'll get onto the client straight away. If you're on LinkedIn, you've not received an invite from me, it's probably because we can't find you. So if your name's John Smith, you probably got as far as page 2 of LinkedIn and then gave up. But if you have received one, please, it'll be from me, but my staff have actually done it. My team have done it. Please link with me, because we do update a lot of what we're doing on LinkedIn. That's our method of choice for keeping people updated, or broker partners updated, and also on future shows as well. If you have liked what you've seen today, this will be sent to you this afternoon as well. You are already registered with us, but to receive commission, we need one of these back. Not to receive a deal, but to actually pay you, I must have a signed agency application back, just to comply basically with lender rules, FCA rules, and all the other rules that are out there. But it's something that we always do. Next show we have on the 7th of July. As always, we're now back to the first Thursday in every month. So we have Jazz from Shawbrook, Charlie from Hope Capital, who still looks so young. I think I've got socks that are older than Charlie by the look of things. We've got the lovely Grace from Family Building Society, and the very scary looking Gary from Castle Trust, who's one of the nicest guys you'll ever meet. And Castle Trust is a lender that we have some exclusives with. So join us next month and you can find out exactly what they are. Remaining shows for you. You can sign up to as many shows as you want. There's always different lenders at each, always covering different products. We would never, ever have 4 lenders covering the same product range. Absolute waste of time, especially when it comes to bridging. I've been to seminars before where you've got 4, 5, 6 bridging lenders all saying we're the quickest, we're the best. Well, they can't all be the quickest. They can't all be the best. So it's an absolute nonsense when I've attended stuff like that. So we always mix it up a little bit just to make sure you've got different subjects that are being spoken about. Okay, on to the feedback and CPD. I mentioned this earlier on when I spoke. When it comes to leaving today's event, in the top right corner, you'll see a box that says event board. Click on that and you'll see a red exit event box. Click on that. You'll immediately get your feedback form. If you do it any other way, if you just close down your browser, this won't happen. So you'll get your feedback form and then your CPD certificate will be emailed shortly afterwards. If you're one of the 10% that doesn't receive it, can you contact us tomorrow afternoon? Because sometimes these two do take a while to come through. Also check the spam folder. So we quite often find that we have people contact us and I haven't received it and they haven't checked their spam. So just have a look to make sure it's not in your spam. One favor I will ask you, obviously, we run these completely free for delegates and completely free for lenders, other than anyone that wants to offer sponsorship. And they do have their name plastered across, as you can see on every single slide. If you can leave a review for us on either Google, just Google, go on Google and search Google Review Specialist Hub or Trustpilot Specialist Hub. Just be careful, there is a firm that has gone on to Trustpilot called Specialists Hub. I believe have gone bust, but they've still got a Trustpilot account open. Just make sure you leave it on the correct one. Big thank you to today's sponsor, West One. As I mentioned before, we have package status across an entire range. Anything you need, so across bridging, development, buy-to-let, second charges, the whole lot, give us a call. But a big thank you to them for today's sponsorship. And very finally, I think this is my last slide. Enjoy the rest of your day. I'm 5 minutes before time. Excellent. Stay prosperous until next month. I'll see you then. Have a good one. Thank you.